Good, guy. Look at that. Boom, boom, boom. You see, when you wait, show you. When you wait, good, guy. Look at here. You're waiting, waiting, wait. That's all. Look at it. Start to pull back here and see break right here. It's short to control again. When this one collapsed down here, it's short in control. Short in control, guy. It's short in control. Look at us. Up 500% right now. Breathe. Crazy, okay? Crazy, crazy. Up 500%. You win some, you lose some. This, look at daily chart. What the heck is that? Look at that guy. Crazy, huh? What the deal? No new guy. Wall Street final is so many. What the heck is that? Nothing. No new. 2 hours ago. Parent may be complete in timely manner, financial conditioning and perform. Got no new at all. Crazy. Look at no new. Still running. 2 hours ago. Reholding will become so many digital asset treasure. Oh, he buy Bitcoin stuff. Treasury guy. So may intend to raw shareholder foundation. Yeah, they try to buy Bitcoin. Cryptocurrency. That's all. Crazy, crazy guy. Everything can happen. Look at 2 minute chart. Look at that. Crazy. All the time. All the time, guys. Let's see how high can it go. Let's see how high can it go, guys. Yep, pull back right now. Just take profit first. When it break out, buy again. When it break out, buy again, guys. Look at the chart. Look at the chart, guys. Up 400% right there. No short, no sweet. Hello, Ken. I got burned on this one, guy. Look at this one. Jumping right here, sail right here, and after that, look at squeeze back up. Crazy. Not easy. Wait a lot. Wait long time. So here, wait how long? Wait at least what? From 10:30, 10 o'clock, about an hour and a half goes free. Crazy guy. All the time. All the time, guy. All the time. Let's see what's going on with this one. Nobody know what's going on. Just react only. Just react only. Got 2 trade only, guy. Here today trade laser. Down a couple $100 right here. $150 right here. Look, right here. Buy 388, 34, 399. My average about 390 and sold right here. Sell right here. Where is that? Where? Sell right here. 363. Lot 20 cent. 25 cent. Right here. Boom. Try to buy here, buy here. Buy here. But not curve back up. I'm out. Out. It's okay. Couple hundreds here. If I hold, if I jump back in right here, I sell right here all the way 263 all the way to 340, 345. Crazy guy. That's the problem. Buy breakout. Buy breakout, you need to jump out real fast. See, buy breakout, I hold right here. Try to curl back up. If not, I'm out. Out, guy. Out, out, out. Right here. Crazy, crazy. jump in right here, curve back up, jump, buy some here at the open. I know this one start go down as a check, that's it. Go all the way down to 260. Boom, curve back up. If not curve, fake breakout, short in control. Boom, get out right here. And then all the way down to another 20 cents. That's a lot. That's a lot, guys. So what you trading, Ken? What you buy and sell? What you buy and sell? Look right here, you need to wait. You can jump in right here, and then waiting, you S on right here, and sell all the way here. Easy resistance right here, guys. This is resistance right here. Easy right here. Right there. Down here, need to get out. Look right here, need to get out right there, guys. Okay? But you wait and see. You buy right here, net time. This is a backside. Try small side backside. Okay? Small side backside, guys. Crazy, holy. Look at this one. See? This one, and power lunch still hold here. It can squeeze. If down here, get out. Wait and see, guys. Wait and see. Support here. Support here. Break here. Boom. Re. Crazy, huh? Re. This one too. All right, here, you see right here? When they pull back, curl all the way back up, pull back, curl up, break here, and you get out. Easy like that. You get out right there, guys. You get out right there. Not complicated. Look at it. This one up 32%. Let's see, curve back up or not. Too many short in control, guys. And no short, no squeeze. No short, no squeeze. No short, no squeeze, guys. Laser test. This one here. I don't want to draw too many lines. Look at here. Read. Read coming down. Read coming down, baby. Curve back up. Let's see. When it break 52, go higher. It's same at LQQ last time. Okay, QMMM last week, QMM last week. Look, QMM. I say break 150 last time. Right here, 150. Right here, guys, 150. Look at it. All the way 150. And I say 150 break out, jump in. Right here, guys, look at that. 150. I remember it. Right here, guys, the chart. Right? You see here, all the way up, pull back, Break 150 all the way to $300. $300, guy, crazy. Same thing, so this time see re, guy. Let's see re. Look at re. Whoa. It jumped here 15 all the way down to $10 this morning. 10 bucks. Up $35 right now. Go back to 52 or no? When it back to 52, break new high. Over here, short squeeze right here, 52. This way, wait and see. Okay, wait and see, guys. It's working. Is it working? Why? Because you are waiting. And you're patient, that's all. Wait and see. $50, $52, go to the moon. 52, you go to the moon, guy. Nobody believe us? Believes it or not? Alright, believe this or not, guy? Do I short? Let's short 100%. It touched 52, short it. No, I don't think so. I don't short that stuff. No short, guy, no short. No short, no squeeze. Is that bear flash? Break down here, go lower. Break down there, go lower. Bear flash. It's bear, guy. Bear flash. So try to control it. So try to control it. $39. Hold it. So try to control it, guys. So try to control. So try to control it, guys. Hold it right now. let's see, 5 minutes chart. Right here, support 38. Man, volunteer, try to break out. Good job in volunteer, choppy. It's all computer trading, guy. Look at it. 20 million here, chop. This one right here, be careful, power lunge, guy. Power lunge, we break 410, you see the moon. Everything can happen. Right here, guy, 410. Power lunge. Alright, this one down here and you get out. Waiting, Mara moving. Bitcoin moving higher, that's why. All right, here's the plan. If this one break here, 52. Break. Go higher. Okay, that's all. 52, guy. If 52 break it, go higher. $52 break, go higher.
is the great and unforgiving teacher. To be reduced to zero is not in itself a mark of failure. It is a rite of passage, a common and often necessary experience in the life of any man who dares to engage with the market on a serious level. The true test of a speculator's character is not whether he can avoid being knocked down, but whether he has the fortitude, the intelligence, and the courage to get back up. This is a clinical analysis of that very process. It is a deep dissection of the art of starting over, of the science of the comeback. And there is no greater case study in this art than the life of Jesse Livermore, a man who repeatedly climbed to the highest peaks of Wall Street, was cast down into the deepest valleys of ruin, and who, time and again, found the strength to begin the long, hard climb back to the top. His story is a testament to a profound and often overlooked truth. That losing everything is not the end of the game, but
it's a nice sunglass
again, wiser and stronger than before.
You look good.
The fact that the speculator's greatest asset is not his capital, but his knowledge of himself and of his own mistakes. The principles that guided his comebacks were not complex or secret. They were the simple, hard-won truths of the market, the very rules he had often violated to bring about his own downfall. His journey is the ultimate chronicle of failure and redemption. The foundational text for understanding this entire philosophy, the very soul of his operation of thinking, was masterfully documented by Edwin Lafayette. A link to his essential work, Reminiscences of a Stock Operator, now with a unique detailed chapter-by-chapter analysis from Max Davidson, is left in the description below this video. This analysis is specially designed to make the timeless wisdom of the book accessible and powerfully relevant to the modern reader. The first of Livermore's great descents into the abyss was a lesson in the dangers of an untested system. He had begun his career as a boy genius, the boy plunger of the Boston bucket shop. In that simple, fast-moving environment, his method of pure tape reading was infallible. He had solved the game. He came to New York with a well-earned stake and an even greater supply of confidence, believing he could apply his bucket shop methods to the New York Stock Exchange with the same spectacular results. He could not. The conditions of the game were fundamentally different. The ticker was delayed. Executions were not instantaneous. The scale of the capital was vastly larger. His old system, so perfect for its original environment, was a useless and broken tool in this new, more complex arena. The market, in its impersonal way, proceeded to teach him this lesson. He was wiped out completely. His capital, the fruit of years of successful operation, was gone.
Right here, read guy.
First experience of
Alright,
from zero.
read from
He was forced to borrow
$10 all the way to it's 400%.
A method is
Read.
only as good as the conditions in which it operates. A speculator must be a student of changing conditions, and he must have the intellectual flexibility to adapt his methods accordingly. His first ruin was the price he paid for his own youthful rigidity. His second great downfall was far more complex and far more instructive. It was a ruin born not of inexperience, but of its opposite. The supreme arrogance and emotional recklessness that can follow a massive historic success. In the great panic of 1907, Livermore had cemented his legend. He had correctly anticipated the crash and...
Come on, rig 52.
...had accumulated a fortune of several $1 million. He was the great bear of Wall Street, a man who had looked into the financial abyss and had emerged a king. It was this very success that laid the foundation for his next failure. A man who has just made a great fortune is in the most dangerous psychological state a speculator can experience. He begins to feel infallible. His respect for the market's inherent risk diminishes. He forgets that he is a student of the market and begins to see himself as its master. This hubris led him to the cotton market, where he intended to become the cotton king. He built a massive, dangerously large position, a line so great that it dwarfed even his most ambitious trades of the past. He was no longer speculating with caution. He was betting with the reckless abandon of a man who believed he could not lose. And crucially, he had allowed his judgment to be influenced by another man, a charismatic cotton expert named He had violated his own cardinal rule of relying only on his own study of the tape. When the cotton market began to turn against him,
42.
he gave him a clear and unambiguous signal to sell. A small loss at this point would have been a minor setback, but his ego and his loyalty to Thomas's bullish vision would not allow it. He held on. He began to hope. He was trapped by the psychological pressure of his own massive position. He was no longer thinking about preserving his capital. He was thinking only about being proven right. He wanted to win it back. This desire to win it back, to recoup a loss by pressing a bad bet, is one of the most powerful and destructive of all the emotional traps. It is a state of mind in which all scientific principles of speculation are abandoned in favor of a gambler's desperate hope. He not only held his losing position, he began to average down, throwing good money after bad, convinced that he could force the market to bend to his will. The result was a catastrophe. The cotton market collapsed, and he was wiped out once more, this time on a monumental scale. He lost his entire multi-million-dollar fortune and was plunged deep into debt. His second great start from zero was upon him. This failure was far more painful than the first, for it was not a result of ignorance, but a result of a willful and arrogant violation of the very rules he knew to be true. It is in the aftermath of such a devastating, self-inflicted loss that a man's character is truly tested. It is easy and it is common to blame the market, to blame bad luck, or to blame the advice of others. The amateur always finds an external cause for his failure. Livermore did not do this. This was the first and most important principle of his ability to recover. He never blamed the market. He knew the market was an impersonal force. He knew there was only one person responsible for his ruin, himself. This act of taking absolute personal responsibility is the cornerstone of all learning in speculation. A man who blames others for his mistakes is a man who is doomed to repeat them, for he has not learned the lesson. A man who blames himself is a man who has the power to diagnose his error and to ensure it never happens again. And so, in the quiet, painful years of his second financial exile, he began the hard work of self-analysis. He pored over his records. He dissected the cotton campaign, tracing his failure back to its root cause, his own ego, his own hope, and his decision to trust another man's opinion over the facts of the tape. He began the practical steps of recovery. He drastically reduced his personal expenses, a lesson in humility and respect for capital. He was forced to borrow a new, much smaller stake, a process that required him to swallow his immense pride. He was starting over not as a king, but as a humble student once more. He had learned that the market does not forgive a lack of discipline.
Yeah, rule number one.
It is a rule of profound simplicity, and yet, in its application, it demands the highest levels of discipline. It is a rule that, if followed without deviation, acts as the ultimate shield against catastrophic loss and the ultimate test of a speculator's judgment. It is his number one rule for every single trade. The principle is this: a speculative commitment, if it is correctly timed, must show a profit almost immediately. If it does not, the position must be closed without hesitation, without hope, and without regret. This was not a mere guideline for Livermore, it was an absolute, non-negotiable law. He was not interested in buying a stock and waiting patiently for it to appreciate over months or years. That was the business of the investor. He was a speculator, and the business of the speculator is to profit from moves, correctly anticipated and correctly timed. An immediate profit was the market's own irrefutable confirmation that his timing was correct. An immediate loss was its equally clear verdict that he was wrong. The average trader, however, operates on a completely different and fatally flawed premise. He buys a stock, and if it declines, he holds on. He tells himself it is merely a temporary reaction, that his judgment is sound, and that patience will be rewarded. His capital begins to erode, but he is sustained by the treacherous emotion of hope. He may even be tempted to buy more, to average down his cost, believing he is acting shrewdly. He does not realize that he is violating the single most important rule of the game. He is reinforcing failure, and in doing so, he is paving his own road to ruin. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. Livermore's great rule was born from his understanding of the line of least resistance. He knew that a stock poised for a major move does not hesitate or equivocate. When the time is right, when the underlying forces of accumulation have completed their work, the stock will move, and it will move with purpose and direction. To enter a trade at the precise psychological moment,
look at Louis guy.
Where this move
Tell you, look at that guy, look at that.
is to align oneself with this powerful
Laser.
emerging force. The immediate profit is the tangible.
You right there, power lunch?
It is the market's own way of saying, your judgment is correct. The path is clear. A loss, on the other hand, is a sign of resistance. It is the market telling you that your timing is premature, that there are still significant obstacles in the path of the advance.
That's it, guy.
It may be that there is still a large amount of
That's it.
stocks to be distributed by insiders, or that the market is not...
This line right important. Look at break this line, boom.
Whatever the reason, the message is the same. The line of least resistance is not yet in your favor.
Buy the deep.
To remain in the position to attempt to fight against this
Read? I don't buy the deep on the
resistance,
read.
is both costly and unnecessary. Livermore stated it with the
Look at that, my laser.
Dearly for the knowledge. Experience has proved.
Look at laser, guy. You buy right here. Look at here. You go up, up, up. 50%. You go not lower. When it break, squeeze, guy. No short, no squeeze. Do I say that? Right here, guy.
Devastating defeats, and the pattern was undeniable.
Look at that, guy. Look at that.
Campaigns
Beautiful.
felt right from the very beginning. His most costly errors were almost always the ones
Look at that.
held on to
Wait,
an
yeah.
unsuccessful trade, hoping to turn it around. This rule is, at its core, a ruthless mechanism for eliminating hope from the speculative equation. Hope, as he knew, is the amateur's greatest enemy, the siren's call that keeps him chained to a losing position.
Last short, short, short. Short all the way down.
No time for hope to take root. The trade was either right or it was wrong. The verdict was rendered not in days or weeks, but in hours, sometimes in minutes. This brutal, immediate feedback loop prevented him from ever becoming emotionally invested.
Right here, guy. Alright, let me tell you what's going on. Alright, here's the deal. Anytime stuff tries to break right here, double top, start to go down, you draw a line right here, go down, down, down. See right here? And you see the bottom, die down, no more short. Short try to cover, you can buy some here. You buy there, underneath here, you get out. And waiting, 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 waiting. And you can buy more right here, boom. That's the way to trade, guys. That's the way to trade.
Not just in money, but in
wait and see, no short, no sweet, guys. No short, no sweet. This one they go to copy.
Source of anxiety and distraction.
Copy, copy, copy. No short, no sweet.
And prevents him from seeing other, more promising opportunities that the market is presenting. His capital is tied up in a failing venture, and his mind is imprisoned by the need to see that one trade vindicated. He is no longer scanning the entire market.
Look at him, keep going higher, guy.
He is staring with desperate focus at a single festering mistake. This is how speculative ventures are allowed to decay into unwilling and often ruinous investments.
Laser.
A man makes a trade intending it as a short-term speculation. It goes against.
Look at this one go all the way down VWAP right now.
Instead of accepting the small loss as his original plan.
VWAP? See, hold VWAP or not?
Telling himself he has bought a good stock at a fair price and is now an investor. Livermore warned against this explicitly.
VWAP right now.
One should never permit speculative ventures to run into investment. It is an act of self-deception, a way of avoiding the psychological pain of admitting a mistake. The journey of a speculator is
Man, a lot of money can be made on Lase.
by the intense pressure of making high-stakes decisions alone.
Look at Lase, guys.
It
Lase,
is
Lase,
easy to
Lase.
lose perspective, to be swayed by the noise of the crowd, or
Lase.
altering your discipline after a series of setbacks.
450?
This is why
More
we
plus
created
or no?
this channel, to serve as a constant
Look
source
at
of
daily chart.
principles.
Not yet.
You can return
All the way to
not just
$7.
to learn, but to recalibrate your mindset.
Right here, resistance right
If you're
here.
a professional speculator, subscribe to our channel and return to these lessons.
See, 420 resistance, break
Not just
resistance.
knowledge, but reinforcement and perspective
Go higher,
when
guys.
needed most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Sikota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world.
Try to put down right now.
Investors. If you wish to broaden your understanding, the link to this new channel is in the description below. Livermore's #1 rule is not a call for frantic minute-to-minute trading. The time frame, whether it is 24 hours or 2 days, is less important than the principle. The principle is that the market's reaction to your entry must be favorable and swift. A stock that is truly ready to begin a great advance does not typically linger at the starting gate. It moves. A stock that stagnates.
Look at this one. Keep holding, guy.
Progress. Or that
This one break right here.
Pressure is a stock
250.
that is advertising its own weakness.
At power lunch,
Its lack of
we go all the way back
To follow this rule
to
is to
280.
demand that the market proves you right. And
Come on,
proves you right
250.
now. It is a shift from a passive
250 with the
to
volume.
active, demanding.
Watching.
The speculator is not a supplicant begging the market for a profit. He is a professional, making a calculated commitment and expecting an immediate return on his investment of capital and judgment. If that return is not forthcoming, he withdraws his capital without a second thought and redeploys it elsewhere. He is a manager of probabilities, and a trade that is not immediately profitable is, by definition, a low probability venture. This rule, then, is...
Look at 250, guy. Look at
It
250.
is the gatekeeper that stands...
Need to break
at the entrance of every
252.
trade. It separates the high probability, correctly timed entries from...
Look
the
right there. 250 star go down. Crazy, yeah?
It ensures
You believe
that
this or
the
not?
capital is only ever committed to positions that are in harmony with the market's immediate current. It is the mechanism that enforces the discipline of timing, the foundation upon which all of Livermore's greatest campaigns were built.
Night ball flash.
Adaptability is to take the first and most critical step away from the mindset of the amateur and toward the cold, calculated, and ultimately profitable world of the professional.
Night ball flash right here.
The power of Livermore's #1 rule. One must first understand what he was looking for in those first critical hours and days after entering a trade. The immediate profit was not merely a financial gain. It was a signal, a piece of vital information.
Volume,
A
guy. Need
confirmation from the
volume.
market itself that his timing was correct and his judgment was sound. But what did this confirmation actually look like on the tape? It was not just a single uptick. It was a collection of specific observable behaviors that take...
Hold the VWAP right here.
That he was in harmony with the market's true...
VWAP, guys. VWAP.
resistance.
Look at that.
The
Look
first
at
and
the
most
VWAP.
important signal of confirmation was the character of the move itself. A stock that is truly ready to begin a great advance does not do so timidly. it moves with force and conviction. When Livermore entered a trade at a pivotal point, he expected to see an immediate and decisive move away from that price level. A stock that churned back and forth, that hesitated and struggled to make progress, was a stock that was advertising its own lack of readiness.
Alright, the backside take long, guys.
Still significant resistance to be overcome.
Backside take really long.
Such a position was to invite the unnecessary risk of a sudden reversal. This movement, he observed, should be accompanied by a distinct increase in volume. Volume is the engine of a price move. A breakout on low volume is often suspect, a sign of a lack of broad participation and conviction. But a breakout on a sudden dramatic surge in activity is a powerful confirmation. It shows that other market participants, the floor traders, the public, and perhaps other informed interests, are seeing the same thing and are acting on it.
Look at right there, guys. Nice ball plus.
Endorsing the move, but providing the fuel necessary for a sustained advance. Another critical sign of confirmation was the
450 resistance.
When Livermore was correct in his timing, he found that accumulating his line was a relatively straightforward process. If he was buying, he might have to bid the price up slightly, but the stock would be available, and the market would readily absorb his purchases without faltering. This was a sign of a healthy, liquid market with broad underlying demand. The trade felt right because it flowed with the natural current of the market. Conversely, if a trade felt like a struggle from the very beginning, it was a profound danger signal. If, in trying to buy a stock, he found that his own purchases were the only thing holding the price up, that the moment he stopped buying, the price began to sag. This was a clear indication that he was on the wrong side. He was attempting to single-handedly fight a tide of selling pressure. This was not a position of strength, but one of extreme vulnerability. The trade was not acting right, and therefore it had to be abandoned. This same logic applied to the behavior of the stock relative to its group and the overall market. Livermore was a firm believer in following the leaders. He knew that the great market trends do not happen in isolation. They are led by the strongest stocks in the strongest industry groups. Therefore, a critical form of confirmation for any new trade was to see sympathetic movement from its sister stocks. If he bought a leading steel stock at a pivotal point, he wanted to see the other major steel stocks also begin to firm up in advance. This harmonious group action was a sign that a broad, sector-wide move was underway. It was a confirmation that his judgment was not based on an isolated anomaly, but on a powerful, underlying current that was lifting all ships in that group. It provided an immense sense of confidence and security. He was not just in a single, correct trade. He was participating in a great, validated market movement. The absence of this confirmation was an equally powerful warning. If he bought a stock and it advanced, but the other stocks in its group refused to follow, or, worse, began to decline, he would grow immediately suspicious. It was a sign that the strength in his stock might be a manipulative move or an isolated, unsustainable flurry of buying. A leader without an army is not a leader. It is a target. He would often sell a position even if it was showing a small profit if its group failed to confirm the move. Ultimately, Livermore's number one rule was a complete, multifaceted diagnostic tool. The profit he was looking for was not just a green number on his ledger. It was a composite picture of market health. It was a decisive price move on convincing volume that was easy to execute, that did not look back, and that was confirmed by the sympathetic action of its peers. When all these factors aligned, it was the market's own unambiguous signal that a great and profitable opportunity was at hand. This is what gave him the confidence to sit tight, to pyramid his position, and to ride the great swings for all they were worth. His confidence was not born of ego or hope, but of the accumulated evidence of the market's own behavior. He had a reason, a powerful and validated reason for his conviction.
See, this is the backside, the part with backside.
This is the great psychological benefit of his rule. It replaces the anxiety of uncertainty with the calm confidence of a confirmed diagnosis. For the modern
You see the
trader,
ball with the
this
backside?
is truth
That's the
is
ball,
a
okay.
century ago. Before you commit your capital, you must demand that the market proves you right. Do not be content with a trade that goes nowhere or immediately goes against you. Do not hold on to a position out of hope. Look for the signs of immediate confirmation. Is the move decisive? Is the volume convincing? Is the stocks group acting in harmony? If these confirmations are absent, you must have the discipline to accept that your timing is wrong. Cut the trade. Take the small loss. Preserve your capital and your mental clarity. There will always be another opportunity, another day, another trade. But that next opportunity is only available to the speculator who has had the wisdom to survive his own inevitable mistakes. This, then, is the ultimate meaning of Livermore's great rule. It is a commitment to trading only the highest probability setups. It is a discipline that forces the speculator to act only when the market's own powerful forces are aligned in his favor. It is a simple but profound method for ensuring that when you are right in a big way, and when you are wrong in a small and insignificant one. It is not just the number one rule for every trade, it is the number one rule for a long and profitable career. Jesse Livermore was, above all else, a master at identifying these market generals. He did not rely on tips, on fundamentals, or on guesswork. He developed a cold, methodical, and profoundly effective process for filtering out the market's noise and focusing his capital only on those stocks that possessed the character and the power of true leadership. This was not a single secret formula, but a multi-stage test. A rigorous examination of every potential commitment had to pass before he would risk a single dollar. It was a process designed to answer one question. Is this merely another stock, or is this one of the chosen few destined to lead to great advance? This process, this leadership test, is a roadmap. It is a systematic four-step guide for moving from a broad overview of the entire market down to a specific actionable trading decision. It is the methodology that allowed Livermore to position himself time and again at the very inception of the market's greatest and most profitable trend. It is a testament to his core belief that speculation is not a gamble, but a serious business. A business that rewards the diligent student and mercilessly punishes the impulsive amateur. This test is not found on a single convenient page in any book, but is a synthesis of a lifetime of wisdom, a collection of principles forged from the heat of the market's greatest battles. To truly understand the mind that divides it, to walk alongside the great bear through the panics and booms where these rules were proven, the essential starting point remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book, it is a deep psychological portrait of a master speculator at work. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. Before we delve into the test itself, we must first understand the philosophy that underpins it. Livermore was adamant that a speculator should never attempt to play the market as a whole. It is dangerous to start spreading out all over the market, he warned. To have an interest in too many stocks at once was to invite confusion and dilute one's focus. He knew that at any given time, the vast majority of stocks are not worthy of the speculator's attention. They are either dormant, moving sideways in a lifeless trading range, or they are weak, lagging behind the general market. The real money, the fast money, the big money, was always concentrated in the hands of the few undisputed leaders. He stated it as a fundamental law. If you cannot make money out of the leading active issues, you are not going to make money out of the stock market as a whole. This was a profound and critical insight. It meant that the speculator's first and most important job was not to find bargains or undervalued situations, but to identify the small handful of stocks that were currently leading the entire market advance. It was a process of radical simplification, of ignoring the 99% to focus on the 1% that truly mattered. This brings us to the first step of the leadership test. Identify the leading group. Livermore never analyzed the stock in a vacuum. He always began with a top-down approach, first assessing the character of the overall market, and then identifying the single industry group that was demonstrating the most power and vitality. He knew that the great market movements were never confined to a single stock. They were sector-wide phenomena. In his day, it was the railroads, then the steels, then the motors. As they go, he said, so goes the whole market. The leading group was not a matter of his personal preference. It was a fact, revealed by the action of the ticker tape. The leading group was the one that emerged from a market correction first, and with the most force. It was the group that made new highs while others were still languishing. It was the group that showed the most consistent and powerful buying, the one that everyone was talking about. To trade against this group, or to ignore it in favor of a weaker sector, was to willingly place oneself on the wrong side of the primary, controlling force of the market. This first step, then, acts as a great, powerful filter, immediately narrowing the speculator's focus from 1,000 possibilities down to a select and manageable few. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Once the leading group has been clearly identified, the second step of the test begins. Identify the leader within the group. Even within the strongest sector, not all stocks are created equal. There will always be one or two undisputed generals leading the charge, while the others follow as mere soldiers in the ranks. The speculator's task is to identify these generals, for they are the ones that will move the furthest and the fastest. They are the true 100-point candidates. Livermore's rule was to always buy the leader, the number one stock in the number one group. The leader, like the leading group, is not a matter of opinion. It is a fact, demonstrated by its behavior. The leading stock is the one that moves first. It is the one that makes the largest percentage gains on the highest volume. It is the one that shows the greatest resilience during market reactions, giving up the least ground and being the first to recover. It is the stock that, in Livermore's parlance, is acting right. It feels strong on the tape. It absorbs profit-taking with ease and seems to be in a constant state of demand. This is where the amateur so often makes a fatal error. He sees the leading stock, which has already had a substantial advance, and he deems it too expensive. He looks instead for the laggard in the same group, a stock that has not yet moved, and he buys it, believing it is a bargain and is due to catch up. Livermore knew this to be a fool's game. He warned, "Experiences have taught me to beware of buying a stock that refuses to follow the group leader." A laggard is not a bargain, it is a weak one. Its failure to advance in concert with its peers is a profound sign of internal weakness, a clear warning of disguised distribution or some other unseen problem. His famous trade in the motor group was a perfect illustration of this principle. He saw the great bull market in automobiles, but he did not buy every motor stock. He focused his capital. At one point, he noticed that Chester Motors was persistently lagging behind the leader.
You guys see that, Lase?
The public,
Look at Lase.
began to buy it.
$5, huh?
Livermore, reading the tape, saw its weakness as a definitive sell signal.
That's crazy, guy.
Profiting handsomely when the stock's internal problems were finally revealed. His great campaign in the steel stocks during the war boom provided the positive example. He began his operation by studying both U.S. steel and Utah copper.
Look at Lase. Short squeak guy.
Beginning, their characters were
520 guy.
U.S. Steel was a true leader. It moved with power and conviction. Every purchase he made was met with higher prices.
Look at this one.
It was acting right. Utah Copper,
250.
in contrast, was sluggish. It lacked vitality.
Need volume, that's all.
He
Need
concentrated
volume.
his full force on the leader, U.S.
This is a good trade right here.
accumulating a massive line while keeping his position in the laggard
Hot
Utah
today.
Copper to a bare minimum. The result was one of his greatest and most profitable campaigns. This second step, then, is the final
Look
and
here,
most
nice,
important filter
nice ball
of the
plus.
selection process. It is the
It's the
discipline
top
to
right now.
bargain
Look at
for
that
the
guy.
bargain and to pay up for the proven strength of the leader. It is
Look
the
right here, look at
discipline
this.
in the business of speculation.
See right here, the
You are
top?
not paid for buying cheap, but for buying right. By first identifying
540.
the leading group and then identifying the leading stock within that
Crazy,
group,
huh?
the speculator has narrowed the entire universe of the market down to a single high probability candidate.
Look
He's
here,
completed the
all the way
most critical
7.
part of his analysis.
This one you can trade couple of days, guy. You can go all the way back to
The
250,
final two steps which govern
270, and then boom, maybe you go up again. Watch out this. This you can trade couple of days.
In the leading group is to have completed the great strategic work of the speculator.
You can trade couple of days. $7, guys. $7.
Found. But for Jesse Livermore, this was where the most difficult and most critical phase of the operation began.
Focus on this one, okay? Focus on this one.
Worthless if it is not paired with flawless timing. To act too soon is to be ground down by the market's indecision. To act too late is to miss the opportunity entirely. The final two steps of his leadership test were designed to solve this one profound problem. Knowing the precise psychological moment to strike, and knowing with certainty that the strike was a success. This brings us to the third step of the test, a step that requires a level of patience so profound it is almost alien to the nature of the average speculator. Wait for the pivotal point confirmation. Livermore knew from a lifetime of costly mistakes that it was not enough to be right about a stock. One had to be right at the right time. A stock that is destined to double in price may first drift sideways for months, or even suffer a significant decline before its real move begins. The speculator who enters prematurely, driven by his own correct but impatient analysis, will have his capital and his nerve exhausted long before the profitable part of the move ever gets underway. He had learned this lesson in the most brutal fashion imaginable. He told the story of a time he was convinced a great bull market in cotton was imminent. His analysis was flawless. His conviction was absolute. But his timing was disastrous. He could not bear to wait. He jumped into the market with a large line, only to see it do nothing, forcing him to sell at a loss. He repeated this 5 times, his impatience chipping away nearly $200,000 of his capital. Finally, in disgust, he abandoned the trade. 2 days later, the real move began, a massive explosive advance that he missed entirely. It was $1 million tuition fee for the sin of impatience. From that day forward, he made it an ironclad rule to never act on his opinion alone. His opinion was merely a hypothesis. The final deciding vote belonged to the market itself. The pivotal point was the ballot box. It was the specific, predetermined price level at which the market would either confirm his thesis or reject it. He would identify his leading stock, he would determine its critical pivotal point, and then he would do the hardest thing in all of speculation. He would wait. He would sit and watch, sometimes for days, sometimes for weeks, his capital held in reserve until the price reached his line in the sand. His legendary campaign in Bethlehem Steel was the ultimate testament to this discipline. For 6 long weeks, he watched the stock climb, his bullish conviction growing stronger with every passing day. He saw it move from the 50s to the 80s to the 90s. Every point of advance was a siren's call to his impatience.
Look at that
The
guy.
profit
Great.
was forgotten. The amateur would have jumped in a dozen times. But Livermore waited. He was not interested in the preliminary skirmishes. He was waiting for the main event, the signal that the great public marking up phase was about to begin. That signal for him was the breach pivotal point at $100.
Another ball plus.
The moment it was crossed, he acted. And in doing so, he entered one of the greatest trades of his career. This leads to the fourth and final step of the leadership test, the ultimate confirmation that transforms a well-laid plan into a successful campaign. Test the initial action. The test is not over once the order
Look at here, this is one guy, look at this, at the rewrap. The rewrap guy, rewrap.
3 steps must now prove its leadership with its own behavior. It must, in Livermore's famous parlance, act right, and it must do so immediately. The rule was simple.
Look at the rewrap.
Experience has proved to me that the real money made in speculating has been in commitments and
Hey,
stocks
Dean.
or commodities showing a profit right from the start.
3 targets.
A true market leader
Ah,
that is truly ready to
you need to
embark
break
on
54.
does not hesitate at its breakout point.
If not break the 54 under 29, you get out all of them. Okay.
With conviction, with a vitality that is palpable on the tape.
Okay,
The
52.
initial commitment
Double top?
must show a profit almost instantly. This was not a desire for a quick gain. It was a demand for immediate confirmation. It was the final, crucial piece of evidence that his timing had been perfect, that he was in complete and total harmony with the market's line of least resistance. If, however,
Here's the plan. Under 29, you get out all of them.
struggle, if it felt heavy,
Under 29, you get out.
or if it quickly sank back below his entry price, it was a clear signal that
Right
the
here,
market
guy.
was full.
Right here.
It was the market.
Look at his support right here, 30.
Set up. The time was not yet right. He would not wait for the small loss to grow. He would not hope for a reversal. He would honor the market's immediate.
Wait for power line another hour and see what happened.
This was the practical application of
Another hour, guy.
every trade. This
But laser, look at laser, guy, laser, look at laser.
From the hopeful gambler.
Another ball flat. Break 540, you see the moon.
He was right. The scientific speculator makes his bet and then
540, see the
he
moon.
tests, and he demands that the market prove him right.
Alright, this one here, target 670, right there.
And the tape's answer,
Look right here.
given in the language of price,
540, resistance, 1, 2,
every
boom.
subsequent move. The complete 4-step leadership test is thus a journey from the general to the specific, a process of systematic filtration.
Right here,
based
540.
on guesswork or emotional impulse.
Look here and see what's going on, double top or what?
The entire market to find
This is good to
the
walk
strongest
right here, guy.
It narrows its focus to the single strongest stock within that group. It demands the supreme patience to wait for that chosen stock to arrive at its own perfect psychological moment to act. And finally, it demands that the stock itself confirm the entire thesis with its own immediate, powerful, and profitable action. This was the roadmap that guided Jesse Livermore to his greatest fortune. It was his method for separating the high probability certainties from the vast ocean of speculative noise. It was a process that required immense study, ironclad discipline, and the courage to act decisively when all the signals finally aligned. He knew that the great 100-point stocks were not found by chance. They were found by a deliberate and methodical process of identification and confirmation. For the modern trader, this test is a timeless and powerful framework. It is a call to abandon the frantic search for tips and secrets, and to begin the serious professional work of a market student. It is a guide to developing a speculator's most...
Look at that guy. Look at that.
Judgment. The market is always providing clues, always telling its story to those who know how to listen. Livermore's great test is, in the end, a method for listening, for understanding, and for acting on that story with the calm, quiet confidence of a master.
Just like that, double my money.
There is perhaps nothing more dangerous in the world of speculation than a brilliant idea. It arrives in a flash of insight, elegant in its logic and seductive in its promise. It feels like a secret key, a map to a hidden treasure that you alone have discovered. And acting upon this raw, untested idea, is the single greatest and most consistently fatal error a speculator can make. The markets are a graveyard for brilliant but unverified ideas.
Look at that
The
guy.
novice trader enters this arena armed with them, collected from forums, whispered by so-called experts, or born from a gut feeling after watching a chart for a few hours. They see a pattern, they form a theory, and they mistake this creative act for sound analysis. They are convinced they are right, and the market owes them a profit for their cleverness. This is the foundation of ruin. Jesse Livermore learned this lesson not through quiet contemplation, but through the painful repeated process of losing his entire stake. He learned that the market has no obligation to reward your intelligence. It does not care about your beautifully constructed theory. It is a force of nature, and it respects only one thing: evidence. An untested trading idea is pure opinion. It is a hypothesis with no data. To risk hard-earned capital on an opinion is not speculation. It is the most reckless form of gambling. You are betting that your singular view of the world is correct, without ever consulting the one source that holds the answer, the historical record of the market itself. This journey from opinion to evidence is the defining struggle of any serious speculator. To understand the depth and difficulty of this path, the timeless chronicle of Livermore's own education, Reminiscences of a Stock Operator, remains the ultimate text.
Is that right? No short, no squeeze, right, guy?
By Max Davidson, which breaks down each of Livermore's trials and triumphs chapter by chapter, is an invaluable guide to these lessons. And a link to it is in the description below.
Right here, I say no short, no squeeze.
The untested idea is that it is by definition a complete unknown.
Wait and see. No short, no squeeze, guy.
Into a battlefield with no knowledge of your weapon's accuracy or your armor's strength. You have no idea of the probabilities. What are the chances of
Right here, guy. Look at this.
When it fails,
I say break right here. Look. Boom. No short, no squeeze.
Without answers to these questions,
Bottom, pull back all the way here, down, 8 plus side here.
Buying a stock when its 50
Right.
moving average crosses above its 200.
If they have no short, they have no squeeze.
The golden cross. It sounds logical.
Look at that, guy.
It
Look
implies
at
a
it.
shift from a long
Beautiful.
downtrend to an uptrend. Many traders have taken this idea and run with it, risking their capital on its apparent soundness. But what
Look,
does this
up
present?
100%.
Does this signal work on all stocks or only some?
Pull back, short, 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 right here.
Conditions or only
This morning, right here. 2
What
times.
is its
Double
statistical
top.
window?
Waiting, waiting, right
What is
here.
its average profit?
Break right here.
Average
Boom.
An
Ball
untested
flat.
idea has no answer.
Ball flat.
It is a question
ball flat.
on which you are betting your entire
If not break
financial
ball
future.
flats, can go down. Don't know yet. I don't want to say nothing. I don't know. That's all. I don't know,
The
guys.
speculator is filled with
See, this morning I keep copy all here, so.
is inflated. I knew it, thinking, my idea is the one.
I say right here, I say, lay, wait, then see, char. No short, no squeeze. Number 3 right now.
When the trade fails, they chalk it up to bad luck, a fluke, or market
I
manipulation.
keep all the chart, guys. I keep
When
all
a
the
series
chart.
of them fail, they are thrown into a state of utter confusion and despair.
Look here, you have to look at the daily chart right here. See, I have the daily chart right here. Look at this.
To trade them, but the truth is they never had a system at
See a
all.
daily chart?
They only had a guess. Livermore, in his mature phase,
The
was
short at the water is short not in control. The long in control right now.
He kept
That's all you need.
records, not just of his trades, but of the behavior of stocks under specific conditions. He was manually backtesting, studying the past to understand the probabilities of the future. He was replacing opinion with statistics. This is what testing provides. It strips an idea down to its statistical soul. The first thing a rigorous backtest reveals is the simple win rate. How often over the last decade and across hundreds of instruments did this idea produce a winning trade? The answer is often humbling and immediately exposes the weakness of many cherished theories. But the win rate is only the beginning.
Alright, look at Reed.
The relationship between the
Read right here,
average
support right there. Look at support, guy, $30.
60% of the time can still be a catastrophic loser if the average loss is 3 times larger than the average gain. Conversely, a system that wins only 40% of the time can be a fortune builder if the wins are multiples of the losses. This calculation produces the ultimate metric, expectancy. Expectancy tells you over a large sample of trades what you can expect to make or lose for every dollar you risk. A positive expectancy is a statistical edge. It is the faint, almost imperceptible tailwind that, over time, will carry you to success. A negative expectancy is a headwind that will inevitably drive you into the rocks, no matter how hard you try to sail against it. Trading with an untested idea is trading with an unknown expectancy. You are, in all likelihood, trading with a negative expectancy. You are paying the market for the lesson that your idea is flawed. The professional speculator does the opposite. They let historical data pay for their education and only risk real capital on ideas that have been proven to have a positive expectancy. This raises the critical question: how does a modern trader who isn't a programmer actually perform this rigorous testing? This is the exact problem that a tool like Quagentia was built to solve. It's a no-code strategy builder that allows you to take your unique trading ideas and translate them into a testable system using plain English and a drag-and-drop interface. You don't write code. You assemble your logic. Quagentia then generates the professional-grade code for powerful platforms like NinjaTrader or TradeStation, allowing you to run deep historical backtests. It's the bridge for the creative thinker, turning your brilliant idea from a dangerous guess into a statistically analyzed hypothesis, ready for the judgment of historical data. For anyone who has ever thought, I have a great idea but I can't code, there's a link to explore this path in the description. The process of testing is a great filter. It allows a speculator to take 100 different ideas and, with cold, unemotional rigor, discard the 95 that are worthless junk. This is not a failure. It is a monumental success. You have saved yourself from the certain financial debt that would have come from trading those flawed ideas. You have preserved your capital, your most precious asset. But this path of the system builder requires immense time and effort. This leads to an alternative, equally valid path for the evidence-based trader. This is the path of leveraging pre-vetted research, which is where a service like Stock Market Guides comes in. Their team has already done the brutal work of filtering. They've back-tested millions of combinations of stocks and patterns to find the small percentage that have a persistent statistical edge. Instead of building from scratch, you get access to their scanner and alerts, which deliver only the trade ideas that have already survived the testing process. It's for the trader who understands the value of a proven edge but prefers to focus their energy on analysis and execution rather than on invention. If your goal is to trade proven setups without the years of development work, the link to this done-for-you research is also in the description. Whichever path you choose, building your own system or using pre-vetted research, requires a level of intellectual honesty that most people lack. It requires you to be more committed to the truth than to being right. For those who have been burned by a can't-miss idea, for those who have felt the sting of a blown-up account, this channel is a place to rebuild. The psychological aspect of this is profound. Trading an untested idea creates a powerful illusion of control. The trader believes they are a master strategist, outthinking the market. They feel they have discovered a secret, a holy grail that no one else sees. This is the siren song of the ego, and it leads directly to ruin. The reality is that this trader has zero control. They are a leaf in the wind, completely at the mercy of random outcomes. They are a gambler at a casino, mistaking a lucky streak for a repeatable skill. The market, like the casino, holds the ultimate statistical edge against all who play without one of their own. Livermore's most devastating failures came when he abandoned his evidence-based rules and acted on an untested idea, often one given to him by someone else. His catastrophic loss in cotton was a direct result of trusting the brilliant idea of an expert, Percy Thomas, over the clear, contrary evidence of the ticker tape. His ego allowed him to believe in a story, and he paid for it dearly. The process of testing an idea destroys this illusion of control, and it is a painful process for the ego. But it replaces that fragile illusion with something far more powerful: genuine, resilient confidence. The confidence of a professional speculator does not come from the outcome of the next trade. It comes from the statistical certainty of their proven edge over the next 1,000 trades. A trader with a tested system can endure a string of 5, 6, or even 10 losing trades without losing their nerve. Why? Because their backtesting has shown them that such a losing streak, while unpleasant, is a normal and expected part of their system's performance. They know it is just statistical noise within a profitable long-term framework. The trader with the untested idea, however, is destroyed by 3 consecutive losses. They have no historical context. They panic. They abandon their idea and jump to the next one, repeating the cycle of hope and despair, forever searching for a magical formula that does not exist. Discipline is impossible without a tested set of rules. How can you be disciplined?
Look at here, this one waiting, guy, waiting for power lunch.
The plan works in the first place. You cannot.
Look at here.
You will inevitably
Beautiful. This is a beautiful one,
sign of trouble because your belief in it is built on
Beautiful
shame.
one.
The greatest risk a speculator faces is not a market crash. It is not a black swan event. It is not a volatile stock. The greatest risk lies between their own ears. It is the unexamined, unchallenged, and deeply held belief in their own untested ideas. It is the arrogance of assuming you are right without demanding proof. Livermore's entire career was a journey away from this arrogance. He started as a boy wonder who could guess the market's next move. He ended as a master who knew that guessing was a fool's game. He learned to subordinate his own brilliant ideas to the humble, tedious work of observation, recording, and confirming. He learned
This is the
that
backside?
in systems,
Yes.
you discover them. The patterns, the tendencies, the behaviors that produce a statistical edge are already there, embedded in the historical data of the market. The speculator's job is not to create, but to listen, to test, and to identify these faint signals in the overwhelming noise. A trading idea begins as a hypothesis. I believe that when X and Y occur, Z is more likely to happen. The amateur takes this hypothesis and bets the farm on it. The professional takes this hypothesis and says, "Show me." They go to the data. They ask the market's history. Is this true? How true is it? And under what conditions is it true? Only if history answers in the affirmative do they proceed to the next step, risking a small amount of test capital to see if the edge persists in live market conditions. The process is slow, methodical, and scientific. It strips all the romance and excitement out of trading and turns it into a business.
Let's see how high can it go, guy.
They come to the market seeking excitement, action, and the thrill of being right. The professional is there for one reason only: to execute a tested edge with relentless consistency. Their work is often boring. Their discipline is absolute. Their success is a byproduct of this process, not a goal in itself. So before you risk another dollar on your next brilliant idea, stop. Ask yourself the hard questions. What is the historical evidence for this idea? What is its win rate? What is its expectancy? What is its maximum historical drawdown? If you do not have precise statistical answers to these questions, you do not have a trading system. You have a guess. The market is an expensive place to find out that your guess is wrong.
Try to break right
The
here.
intelligent speculator uses the cheap data of the past to filter their ideas, rather than the expensive data of their own trading account. The final lesson is this: the market does not pay you for having ideas. There is no reward for creativity or cleverness. The market pays for one thing and one thing only: the disciplined execution of a statistically validated edge. To turn your untested ideas into such an edge is to turn gambling into speculation, and to turn speculation into a profession. The This isn't a story about millions. It's not a Wall Street fairy tale. These are my rules. Rules that built fortunes. Rules that buried the arrogant. Rules that can protect your capital and sharpen your edge, if you're wise enough to follow them. I didn't guess. I never trusted luck. I watched. I waited. And when the time was right, I struck. Hard. Most traders lose because they want action. They confuse movement with progress. They gamble. I didn't gamble. I operated. And now I'm going to give you the same rules I followed, the same rules I lived by, so that you don't have to learn the hard way like I did. Follow my rules, or lose everything. Before we begin, subscribe now, like this video, and leave a comment. That simple action helps more people see this content. And it tells me that sharing these lessons still matters. Now listen closely, because these rules were written in blood. My own. The market is never wrong. You are. There is only one side to the market. Not the bull side or the bear side, but the right side. And the market is never wrong. Ever. You are. The sooner you accept that, the sooner you stop trying to outsmart something that doesn't even know your name. In my early years, I made one of the worst mistakes a trader can make. I tried to predict the market. I had a theory.
Come on, break it.
I even had confidence. But the market doesn't care about your confidence. I remember watching a stock push upward with strength, volume, momentum, everything was there. But I thought it had gone too far, so I sold short. I bet against the trend. You know what happened? The trend didn't care. The stock kept rising. I lost. Badly. That moment branded itself into my memory. I realized the market doesn't punish you because it's cruel. It punishes you because you refuse to listen. From that day forward, I stopped fighting the tape. I stopped trying to guess what should happen and started reacting to what was happening. If the market tells you it's going up, you follow. If it says it's going down,
it's going down.
Never argue. Never try to prove the market wrong.
Yep.
You'll only bankrupt yourself trying. Your opinion doesn't move the market. Your money does. And if your money's on the wrong side, you're finished. Buy what's going up, sell what's going down.
Come on, break it, guys. Break it.
Simple, but don't let its simplicity fool you. It will make or break your career. It never was my thinking that made the big money for me. It always was my sitting. I didn't buy stocks because they were cheap. I didn't buy them because I liked them. I bought them because they were moving up. Momentum isn't random. When a stock rises on volume, it's not a fluke. It's a signal. A signal that someone knows something. A signal that money is moving in. Most traders do the opposite. They try to catch the bottom. They look for discounts. But cheap stocks are cheap for a reason. Because no one wants them. I made my biggest trades on stocks that were already climbing. Railroads, steel, oil. The public called them overbought. I called them winners. Let me be clear. When a stock breaks out to new highs, and it does so with conviction, that's not the time to hesitate. That's the time to act. Same rule applies in reverse. If a stock is falling, don't try to be a hero. Don't try to guess where it might bounce. Sell or stay out. I made money by riding waves that already started, not by trying to start my own. The trend is your ally until you decide you're smarter than it. Then it becomes your executioner. This is not about catching the first penny. This is about positioning yourself in the direction of strength and staying with it until the market says otherwise. Never enter without a clear entry point. There's no room for hope in trading. Hope is not a strategy. Confirmation is. I never bought because I felt like it was the right time. I waited for the market to show me it was. Most people lose money because they want to do something. Anything.
Come on, break it.
They think trading is about being active, but trading is about being precise. I studied the tape. I learned to recognize what I called pivotal points. Moments when price action confirmed a real shift. Not noise, not emotion, actual market intent. I'd sit and watch for hours, sometimes days. And when that point appeared, when the stock broke a level with volume with strength, that's when I entered. Never a second before. Let me give you an example. There was a stock trading sideways for weeks. Most had given up on it, but I watched, quietly. I saw how it refused to go lower, how volume started creeping in. Then, bang, it broke through its resistance. That was my green line. I didn't chase noise, I waited for clarity. If you enter too early, you expose yourself to randomness. If you enter too late, the opportunity is gone. But if you enter with confirmation, with discipline, you give yourself an edge. I never guessed. I position. Let me repeat. Don't anticipate the market. Let it tell you what to do. Position size matters. I never went all in. Only fools do that. Position sizing is not just risk management, it's strategy. I built my positions as they proved themselves. If a stock moved in my favor, I added. If it moved against me, I cut or stepped back. Let me make this crystal clear. You do not double down on a loser. You add to a winner. When I entered a trade, I didn't buy my full size at once. That's gambling. I would start small, test the waters. If the trade began to work, if the market confirmed my direction, I'd increase size. Gradually, intelligently. Here's how I did it. Suppose I planned to buy 3,000 shares. I'd begin with 1,000. If the stock advanced and held, I'd buy another 1,000. Only if it continued to confirm strength, I'd buy the last 1,000. That way the market paid me to increase my risk. Not emotion, not prediction, just logic and momentum. I was never afraid to go big, but only when the trade earned it. Too many traders blow up their accounts because they bet everything on their first move. They fall in love with the idea, and then they lose, fast. Your position should never be bigger than your discipline. Risk is always present. But when you build size based on strength, you shift the odds. I didn't build empires overnight. I built them one confirmed move at a time. Exits matter more than entries. Anyone can enter a trade, but only the disciplined know when and how to exit. And make no mistake, how you exit determines whether you win or just get lucky once. In 1907, I made my first real fortune. Not because I caught the top, not because I predicted the exact moment of the crash, but because I knew when to get out. While others held and hoped, I sold. I didn't need to time perfection. I just needed to protect profit and preserve capital. I followed the same rule every time. When the market tells you it's done, believe it. I'd watch price action shift, volume dry up, momentum weaken. These were not accidents, though they were signals, and I acted. Most traders don't fail because they can't find good entries. They fail because they let winners turn into losers, because they let hope replace discipline. I never married a trade. I never held just a little longer because I wanted more. If the market turned, I turned with it. Sometimes that meant giving up potential upside, but more often it meant keeping what I earned while others watched theirs evaporate. It's not how high it goes, it's what you walk away with. So remember this, you make money when you exit, not when you enter. A good trade isn't complete until you close it, on your terms, not the market's. Don't listen to advice, listen to the market.
Yep, listen to the
Let me
market.
be honest with you, the worst losses of my career didn't come from bad trades. They came from listening to people, brokers, friends, newspapers. They all had opinions.
Listen to the
Sometimes those
market.
opinions sounded brilliant, but they weren't based on the tape. They weren't based on the price. They were based on ego, emotion, or noise. One time I ignored what the market was telling me, because someone I respected gave me inside information. The result? I held when I should have sold. I waited when I should have acted. And I lost. Badly. That was the last time I let someone else's voice drown out the message of the market. From then on, I listened only to the one thing that mattered. Price action. The tape doesn't lie. It doesn't care about rumors, opinions, or predictions. It shows you what's real. Volume. Direction, momentum. People will always try to sound smart, but the market doesn't reward sounding smart. It rewards being right, and that comes from watching, not talking. I trusted the market, and only the market. So here's my rule. Don't take tips. Don't follow crowds. Don't outsource your brain. If you can't trust your own analysis, you have no business trading. Learn the market. Read the tape. Build your edge. And when everyone's shouting, you stay silent and let the chart do the talking. Separate emotion from execution. Trading is not emotional, but traders are, and that's the problem. A man must believe in himself and his judgment if he expects to make a living at this game, but he must also act without emotion. I've made and lost fortunes, not because my system failed, but because I let fear, greed, and ego take over the controls. I've chased trades I had no business entering. I've hesitated on trades I should have executed instantly. Why? Because I was human. But I learned, painfully, that emotion is your enemy. It clouds judgment. It delays action. It whispers lies. You see, the market is already difficult. But when your emotions become part of your decision-making, now you're fighting two battles, the external and the internal. I had to build habits, rituals, rules I followed regardless of how I felt. If a trade hit my stop, I got out. If the signal came, I entered. No hesitation, no hope, no panic. Was it easy? Never. But necessary? Always. Discipline is what takes you from gambler to operator. I kept records. I reviewed my trades. I studied my own behavior as much as I studied the market. Because I knew even the perfect system will fail if you sabotage it with your emotions. The biggest profits come when you do nothing. Let me tell you a truth that most traders never learn. The real money is made in the waiting, not in the trading. Everyone wants action. Everyone wants to
waiting, guy.
They think activity equals progress. But that's a lie. Some of my biggest profits came when I did absolutely nothing. I entered the trade, the setup was there. The price
Be careful, $30.
And then I just sat. I didn't tinker. I didn't lock in small gains. I didn't try to be clever. I sat. I waited. I let the market work for me. Most traders destroy their profits by overmanaging. They cut winners too early. They chase new setups instead of letting a good one run. Why? Because doing nothing is hard.
Have you guys seen this one? Dude run like crazy. Look at Dude, guy.
You gain control when you learn to let go.
Guys, see Dude?
And it's true.
Everything can happen, guy. Everything.
It was always my sitting. When the trend is in your favor, your job is not to outthink it.
You see right here? Look at that.
I built empires by sitting on trades while others
Squeeze right now.
second guessing and scalping pennies. You want to know the secret?
Double top 280.
More than talent. Discipline to enter.
Problem pick up.
Discipline to exit is crucial, but discipline to wait, that's where the fortune lies. Learn from losses, don't excuse them. Losses are part of the game, but how you react to them defines whether you stay in the game or get wiped out. There is nothing new on Wall Street. There can't be, because speculation is as old as the hills. And still, every generation repeats the same mistakes. When I lost money, it was never because
all the way down here.
Me. It was because I betrayed my own rules. I once made a fortune, then gave it all back. Not because the system stopped working, but because I stopped following it. I broke my own discipline, ignored my stops. Let pride speak louder than price. And then came the loss. It wasn't just money, it was time, it was momentum, it was confidence. But I didn't make excuses. I didn't blame the market. I sat with it. I analyzed the mistake, and I rebuilt, with sharper edges and fewer illusions. Every mistake carries a lesson. Most traders ignore it. That's why they stay broke. Losses are tuition. If you don't learn, you pay for nothing. You want to become a real operator? Then stop protecting your ego. Start protecting your capital. Don't justify a bad trade. Dissect it. Write it down. Study it. Because the only thing worse than a loss is repeating it. Success is a system, not intuition. If you remember only one thing from everything I've told you, let it be this. Success in trading doesn't come from feeling. It comes from structure, from rules, from system. I didn't rely on luck. I didn't trust my gut. I built a system, and I followed it. Rules for entry, rules for exit, rules for size, rules for sitting, rules for loss. Each one protected me from myself.
Look at this guy. Look at that. See right there? 250.
Cost them their account. The pros say, I waited for confirmation. I followed my plan. I stuck to my system. That mindset built empires. Don't chase perfection. Don't chase magic setups. Chase consistency. Because in this game, it's not about being brilliant. It's about being repeatable. If your strategy can't survive your emotions, your drawdowns, or your mistakes, it's not a strategy. It's a bet. I lost everything, and I came back because I had rules, because I had structure, because I didn't let...
Look, draw a double line, guy. If they break right here, go higher.
Then stop guessing. Start building. Build a system. Stick to it. Adjust it. And respect it more than your own opinions.
Right here, guys. Right here.
You need discipline. You need control. You need rules. Follow my rules, or lose everything. If these words hit you hard, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters.
Let's try to break down right here. Try to short right here, guy.
To the novice, this sounds like an impossible, almost naive piece of advice. How can one engage in the perilous art of speculation and never experience a loss? It seems a paradox, a goal so unattainable that it is dismissed as mere hyperbole. But for Livermore, this was not a literal instruction to achieve perfect, unbroken victory.
Oh, here, look, double top.
It was the bedrock of a profound philosophy, a strategic imperative that
For you,
separated the professional from the amateur.
you can tell right there.
From the vanquished. To him, never lose your money did not mean you would never take a loss. It meant you must never, under any circumstances, lose your capital. It meant your primary objective as a speculator is not to seek astronomical
Look at this one.
but to ensure your own
See right there?
survival in the game.
When they go down, you go down. You get out. When you go down, you get out.
Without a defense was to invite annihilation. The speculator's capital is his ammunition, his lifeblood. To lose it is to be driven from the field, unable to fight another day when a truly great opportunity presents itself.
All right, marijuana guy, theory.
Every action he ever took was built around this single central tenet, the preservation of his trading stick. He understood that fortunes are not made by a single brilliant play, but by the cumulative effect of being right more often than wrong.
All right, Tory, try to move higher.
Wrong was always kept to an absolute manageable minimum.
Right there.
This was the true meaning of his unwritten plan.
Tory.
It was a declaration of war against the speculator's greatest enemy, the catastrophic loss. This principle was not a matter of abstract theory, but of hard-won experience. Livermore's own journey was a testament to its importance. He had been flat broke several times, his millions vanishing as quickly as they had appeared. Each time the climb back was a brutal...
Look right here, double top. You see that? So easy, huh?
He learned that the skills...
Easy, guy. Easy, easy.
And psychological control...
Look at laser. Laser go down, down, down.
...of capital preservation. To lose your money was to lose.
Come on, break 36.
To lose your chance was the ultimate failure for a man whose entire life was the
Yep.
market.
Right there, squeeze again, guys.
Wiped out is a man without a profession.
The short right here. Look at that,
To
guys.
immerse themselves in the full narrative of this master's journey, to understand the mistakes that shaped him and the victories that defined him.
Here the plan. See, double top. Go down. Support here, $5. Break 5. Go all the way down.
Below, you will find information regarding a unique edition that includes a new.
This one needs to break right here, 42.
By Max Davidson, an analysis specifically designed to translate the book's profound wisdom for the modern reader, making its lessons more
That's
powerful
sweet right
and
there.
accessible than ever before. The first and most immediate application of this philosophy is the rule of the small loss. Livermore learned, through painful and costly experience, that the first loss is always the best loss. This became a non-negotiable tenet of his trading. When he established a position, he did so with a clear expectation of the market's immediate behavior. If the stock did not act as it should, if it did not show him a profit right from the start, he did not wait, he did not hope, and he certainly did not argue with the tape. He cut the trade without hesitation. He viewed such an action not as a failure, but as a necessary and prudent business expense. He saw that the average speculator does the exact opposite.
Here. All marijuana go higher now, guys. Marijuana.
By the hope that the market will reverse and vindicate their judgment.
Marijuana. Some good news on marijuana.
This is a siren's call leading directly to the rocks of financial ruin. An initial small loss, left unattended, festers and grows into a monstrous one, crippling the account and clouding the trader's mind. Livermore understood that a loss is not just a financial deficit, it is a psychological poison. It erodes confidence and distorts judgment, making a comeback infinitely more difficult. This is why he so vehemently condemned the practice of averaging down.
Marijuana, guy, moving.
To buy more of a stock that has already proven your initial judgment wrong is, in his view,
Some good news on level schedule 3.
On an error, to throw good money after bad in a desperate attempt to salvage one's ego. The market is providing clear evidence that the timing is wrong, yet the trader who averages down chooses to ignore this evidence. He is, in effect, telling the market, "You are wrong and I am right," a statement that the ticker tape has a brutal and consistent way of refuting. Livermore treated every trade as a test of his thesis. If he bought a stock expecting it to rise, it needed to rise. If it fell instead, the test had failed. The correct response was not to alter the terms of the test, but to accept the result and close the experiment. This required an almost inhuman level of emotional detachment, the ability to admit a mistake without it wounding one's.
Look at right there, guy, moving. Keep
His
moving.
focus was never on being right in every single instance, but on making big money when his judgment was correct, and losing.
You need to break 40.
He famously stated that profits can always take care of themselves, but losses never do. A speculator must act as his own insurance broker, and the only way to insure himself against a catastrophic loss is by taking the first small one. This keeps the account healthy and the mind clear, ready for the next opportunity. It is a simple principle, yet its consistent application is what separates the fleeting success of the plunger from the enduring career of the professional. To cut a loss quickly is to pay a small tuition fee for a valuable market lesson. To let it run is to risk your entire education fund on a single failing grade. This philosophy of capital preservation was not just an abstract idea. It was codified in brutally effective mechanical rules. One of the most powerful examples of this discipline was not his own invention, but one he admired so much that he chronicled it in detail. The method of the professional gambler, Pat Hearn. Hearn approached the market not as an investor or a visionary, but as a man playing a game of odds, and he devised a system to ensure those odds were always tilted in his favor. His strategy was a masterclass in protecting capital while pyramiding a position. Hearn would never take his full line at once. He would begin by buying a small lot, for instance, 100 shares. if the stock then moved up by 1%, and only then would he buy another 100 shares. He would continue this process.
All right, look at this guy, marijuana.
Increments, but only ever on strength. He was always backing a winner, letting the market itself confirm his judgment before increasing his bet. This prevented him from ever being heavily committed to a position that was not already showing him a profit. The true genius, however, lay in his stop-loss technique.
All right, look at marijuana.
He would immediately place a stop-loss order exactly 1 point below the price of that most recent acquisition. As the stock climbed and he added new lots, his stock would trail up behind it, always anchored to the latest purchase. If a reaction of just 1 point occurred, his last lot would be automatically sold out, crystallizing a tiny, insignificant loss on that single portion, while leaving the core of his profitable position intact. This method made it mechanically impossible to lose more than a single point on any part of his pyramid. It was the ultimate embodiment of cutting losses.
15 more minutes, power lunch.
Room to grow. It protected not just his initial stake, but also the paper profits he had accumulated along the way.
15 more minutes, guy, power lunch.
A trader who, after making a fortune using Hearn's system, grew overconfident, abandoned the strict stop-loss rule, and was promptly wiped out. It was a stark lesson. Discipline is not a part-time commitment. The rules are there to protect you from yourself. Livermore's own system, while more complex and reliant on his reading of the tape, was built on the same foundation of discipline. He knew that the greatest danger was not being wrong, but staying wrong. A stop-loss, whether it was a mental one triggered...
All right, VBS setup and power lunch.
...on a broker's book, was not a
if this one not break, power lunch, VBS right here, the beware.
It was the mechanism that ensured he would always be able to come back and play the game another day.
Okay, power lunch guy.
Never lose your money, a practical strategy rather than an empty slogan. As a speculator's experience deepens, he learns that preserving capital is not just about cutting losses on bad trades. It is equally about not giving back the profits from good ones. Livermore's methodology for protecting his winnings was as systematic as his approach to cutting losses. He was
alright, right here, VBS setup, power lunch.
Simply looking for the signs of its conclusion.
In power lunch, 11:30.
Simple but powerful observation of a reaction.
It's not underneath the beware.
In any healthy
That's a good setup, good squeeze right there, guy.
Experience a natural pullback or
power lunch,
and then resume its climb to a new high. This pattern of advance is the heartbeat of a bull trend. Livermore had the patience to sit through these normal reactions knowing they were part of the game. But his patience was not infinite.
If this one not break underneath the beware, you can squeeze, guy. Be careful. Head and shoulder right now.
Failed to make a new high. He took it as a clear warning that the buying power was exhausted. The upward force was spent. This was a signal to sell. He did not wait for the stock to collapse. He did not need a newspaper headline to tell him something was wrong. The tape itself had told him everything he needed to know. The failure to rally after a reaction meant the line of least resistance was no longer upward. The stock was now a candidate for sale, because to hold on was to risk giving back a substantial portion of the profits he had so patiently accumulated. It was another facet of not losing money, the money that was
already... break here, when it break here, A for setup.
This principle was further refined by his intricate system of pivotal points. A pivotal point was a price level of strategic importance. When a stock broke through such a point, it was expected to continue its move with force. The confirmation or lack thereof provided his mechanical trigger. If a stock broke a pivotal point to the upside but failed to follow through with any real power, it was a danger signal. It showed that the expected strength was not there, and it was often a sign of distribution by insiders. More importantly, these pivotal points gave him a concrete rule for exiting a profitable trade. Once an upward trend was established, the low of the last natural reaction became a critical support level, a low pivotal point. If the stock on a subsequent decline broke that point by a margin of 3 points or more, it was a definitive, mechanically triggered signal that the entire entire upward trend was over. There was no room for debate or hope. It was a clear mathematical instruction to sell and protect his profits. This system removed his own fallible emotions from the equation, forcing him to act on the market's own cold, hard facts. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as
You
a
call me back,
constant
okay?
source of timeless principles.
You call me back, okay? Robert here.
Not just to learn,
Mình chưa có một TLRY không? 700 share nhé không? Mình nói you mua, you có mua hay không gọi lại.
Visit these lessons when you need them most, and let the wisdom of the masters be your guide. For a trader of Livermore's scale, the question of selling involved more than just timing and price signals. It was a complex problem of logistics. The principle of never lose your money took on a new dimension. How to convert a colossal paper profit into actual cash without causing the market to collapse under the weight of his own selling. An amateur with 100 shares can sell at a moment's notice. A professional holding 100,000 shares must find or create a market to sell to. Livermore understood that the greatest liquidity, the most voracious public appetite for stocks, appears at the very end of a bull move. This is the phase of mass euphoria, when the public, having watched a stock double or triple in price, finally casts aside all caution and rushes in to buy, fearing they will miss the final glorious ascent. For the professional who has been patiently holding his line, this is not a signal to become greedier. It is his God-given opportunity to sell. He is not selling at the absolute peak in terms of price, but he is selling at the peak in terms of marketability. He knew he had to sell when the selling was good. He could not wait until the market turned and demand evaporated. He once recounted selling his entire line of 72,000 shares of U.S. steel in a single day, an operation that was only possible because there was a great big market with a tremendous power of absorption. He sold into that strength, feeding the stock to the hungry public.
Alright, this one need to break 40, guy.
His objective was not to squeeze the last eighth of a point from the move, but to liquidate his massive position.
You guys see that? Look at here, double top right there. Try, double top. When it break right here, you see the moon, okay?
Activity and strength that excites the public and confirms their bullish.
When it break higher, get in. Wrong, get out.
That the end is nigh. The tape should tell the story the manipulator wishes its readers to see, and that story is one of strength and activity. But this is done to create buyers. The big selling,
look right here,
maintained, is done on the way down.
It got to $3, alright? When it break right here, look at here. You see right here, guys? Look. Break right here, boom.
Clinical detachment. To sell a stock while it is still strong and the news is still good feels counterintuitive to the average person. But for the large-scale operator,
come on, squid.
Course of action.
Power lunch.
It is the practical application.
8 more minutes. Look at that, guys. Look at that. Squid.
The paper profit is a vaporous, intangible thing. It only becomes real when it is converted to cash in the bank. Livermore's genius was in his recognition that the moment of maximum public greed was his moment of maximum opportunity to ensure his profits did not vanish. In the final analysis, the phrase, never lose your money, as practiced by Jesse Livermore, was not a single rule, but a complete, integrated philosophy of speculation. It was a system of thought and action designed for one primary purpose, to survive. But without survival, there can be no opportunity for victory. It was a complex tapestry woven from threads of discipline, observation, and an almost religious respect for the market's own verdict. It was the understanding that a speculator's business is not to be right all the time, but to be right about the big moves. This philosophy demanded that he cut his losses with the speed and dispassion of a surgeon amputating a gangrenous limb, knowing that to hesitate was to allow the poison to spread. It required the mechanical discipline to set and honor stop-loss points, removing his own fallible emotions from the critical moment of decision. It insisted that he never argue with the ticker tape. that he accepted judgment as final and absolute, regardless of his own opinions or desire. And it taught him the professional art of selling into liquidity, of converting his gains into tangible capital when the market provided the opportunity.
Bữa trước có mua chưa?
These were not just theories, they were the laws by which he operated. Learned through years of ruin.
Thì đúng rồi, thì kể đây bây giờ tầm 08.
He understood that the stock market is the ultimate.
Cái thằng kia với con kìa, cái thằng SRP á. SRP nhớ không? Mua có 2 đồng mấy.
The only ally the speculator can truly count on are his own sound
Đúng
judgment
em.
and the discipline to act.
Quýnh tại chú gối có 200 bạc là mấy chục phút gì nữa. 300 cỡ đó thôi. Thì mày có 300 mấy chứ mấy. 500 thì good. Còn lên nữa.
500 bây giờ nó là 567 đồng rồi.
Ok, muốn gì nữa, ok. Mình bỏ vốn hết, mà mình quýnh nó đúng chứ không phải là tiền, ok. Khi đúng là đúng. Còn với thằng kia đầm mấy á. Good, không sao hết. Nó sẽ 700 là đúng rồi. Nhưng bữa lên lời 5 cent, lời 350 là đúng rồi. Vậy thôi. Khi nó lên là nó lên thôi. Đang chuẩn bị lên. Biết trước mà. Không mà thấy dễ vậy chứ. Biết không? Tao đang livestream á trên YouTube á. Thằng này lên 500% luôn đang coi. Brea. Thì ta đang livestream á, ngồi coi là biết rồi. Brea. B chữ R đó, Robert đó, E là elephant đó.
He knows that his job is not to trade, but to make money. And he knows that the money is made by one perfect moment when the odds are overwhelmingly in his favor.
ABC đó.
Brea. The ultimate expression of mastery. Now consider the great foundation of trading in harmony with the general market.
Yep.
In the market with its meme stocks and its sectors,
sáng có 10 đồng, bây giờ 38.
It can be tempting to believe that an individual.
Coi livestream YouTube, lên YouTube coi.
The amateur is constantly searching for
Lấy nó coi, tập coi đi.
This one company that will soar while the rest of
Cái kia 700 xe ngon á, ok. 700 xe nhất tí là mày đủ ăn rồi, ok. 10 cent là mày thấy 70 bạc rồi, muốn gì nữa. Bây giờ ăn 2-3 cent, từ từ lên tầm rưỡi chứ. SUV thì không có sợ, thằng TLRY á. TLRY á, ngon lắm á, ok. Bữa trước bữa trước giờ xuống đồng là mua đã nhất. Xuống đồng lễ năm. Thì đúng rồi mà tao biết nó lên thì tao cứ mua đại vậy thôi, chứ tao có canh được đâu, ai mà rảnh canh. Kệ nó chuyện hơn. Tầm lễ 5, tầm 10 là chuyện hơn thôi. Thì đúng rồi, đừng có sợ thôi. Bây giờ đang lên quá chừng nè. Lên nhanh không? Tại tao không có babysit với tụi bay biết không? Chứ đáng lẽ là mua rất ít, cái từ từ xuống cái mua nữa. Bắt đầu nó lên, đó. Là lời 200 cent, lời 100-200 rồi đấy. Nó lên là nó lên. Cái đó không có dính líu với tao. Không dính líu gì hết. Cái này nó dột lên nhanh lắm rồi cái. Từ coi tao cái này top secret tao chỉ ai. Cái SRP đó, cái SRP đó mày mua 2-3 ngàn là kiếm $1,000 thôi. Đúng không? Mày chứ $4,000 là lớn lắm rồi phải không? SRP mà ta vừa coi lúc đó là đúng nhất ta kêu mua liền. chang mua xong nó lên liền, lên được 20-30 cent muốn gì nữa.
The tools and the players have changed, but the
Rồi lên khoảng 15-20% muốn gì nữa.
emotions of hope, fear, greed, and ego has not changed.
Trời ơi, lên vậy là nhiều lắm rồi kìa. Từ 2.8, 2.7 mà còn 3 đồng mấy rồi muốn gì
Is
nữa.
not the one with the fastest computer or the most complex algorithm. It is the
Bán nhà mua là mày giàu
most
liền.
disciplined character.
Đó, cái thằng này mà lên quá chừng kìa. 42 đồng rồi. Hồi nãy ta nói rồi 38, 42. Coi đi. Lên YouTube đâu có không? Biết không á? Đang livestream nè. Đang nói chuyện mày livestream luôn nè. SOP. Tao nói 11 giờ 30 nó nhảy là nó nhảy. 11:30. Y chang. Okay, rồi.
It arrives with the brutal and unambiguous verdict of the ticker tape.
Come on, guy. 11:30, guy.
His own weakness or his own lack of discipline.
11:30. See, guy.
Education in the realities of the market. A great success, however, is a subtle and charming poison. It is the most dangerous intoxicant.
You can see right here, 11:30.
Whispers in a man's ear.
Right there, power lunch.
That he has solved the puzzle.
Not kidding, guy.
Instrument upon which he can play any tune he wishes. It is in the warm, triumphant glow of a great victory that a speculator's worst and most fatal mistakes are almost always.
Robert King. Let's go, 11:30.
The life of any speculator who achieves a monumental success.
SRP theory start to move.
To this grim cycle. His greatest and most catastrophic downfalls did not come when he was struggling. But when he
The guy don't know nothing and they tell I came to buy theory and SRP at 280.
The story is a profound and timeless cautionary tale about the seduction.
SRP guy.
It is a clinical analysis of the psychological traps that are sprung not by defeat, but by victory. It reveals how the very emotions that accompany a great win, the surge of confidence, the feeling of infallibility, the hunger for an even greater prize.
All right, look at this one. I have to buy right here, guys.
Pushing toward the abyss of a new.
Buy right here, SRP. What do you want me to do? Right here. Boom. Right now, all the way there. Crazy.
Is a central and recurring theme in the one indispensable.
Look at this one. Crazy guy.
The story of Livermore's triumphs and his subsequent self-inflicted defeats is chronicled with brilliant clarity by Edwin Lefebvre. A link to his essential work, Reminiscences of a Stock Operator, now with a unique, detailed chapter-by-chapter analysis from Max Davidson, is left in the description below this video. This new analysis is specially designed to make the timeless wisdom of the book powerfully relevant to the modern reader. To understand this phenomenon,
the VBS setup, guys, right here, the VWAP. Under the VWAP, you need to get out. If not, you can give it.
He has correctly anticipated a major market move. He has backed his judgment.
Right here, guys, the VBS setup.
With a fortune. He is for that.
Can go to double top. Be careful, double top, 52. Okay, guys.
He has been right in a way that has been.
$50 right there, guys. Be careful.
The world looks upon him as a genius, and what is far more dangerous.
You be careful at 50. You be careful at 30. 30, 50.
A state of profound mental intoxication. The powerful and addictive emotions of triumph and validation flood his mind. He feels that he has not just analyzed and profited from the market. He feels that he has, in some fundamental way, conquered it. This feeling of infallibility is the first and most dangerous symptom of the disease of success. The man begins to believe that the laws of the market, the laws of risk and probability that govern all other men, no longer apply to him. He has ascended to a higher plane of understanding. The first casualty of this new state of mind is the speculator's most essential and protective quality, his humility.
Man, look at here. Look at this one. See, remember this?
Maintains a deep and abiding humility before the market. He knows that he is a student.
Remember this? Look at that guy. I say break right here, 250. Go all the way to 280. Start to go down because this is a double top. Crazy. I draw the line already, guys. I draw a line before it happened.
He is grateful for
I draw the line, guy.
But he does not
330. Right there.
The man who has been seduced by his own victory, however, loses this perspective.
How do I know?
He begins to
I don't
believe
know,
that
tell
the
you the
market's
truth.
trend was not a force that he correctly
I don't know,
diagnosed
guys.
and
Look at it.
followed,
Look at
but a
it.
force that he, through his own genius, somehow commanded. The student begins to
I don't
see
know,
himself as a
guys.
master.
I really don't
This
know.
subtle but profound shift in mindset is the beginning of the end.
I don't
The
know.
moment a man stops listening to the market and begins to listen only to the sound of his own applause, is the moment his next great...
Alright, clear everything. I don't
The
know.
second symptom that follows
Let it
is the
run.
quiet and blatant abandonment of his own time-tested rules. The entire science of speculation is built upon a foundation of rigid, inviolable rules of risk management. These rules are forged in the fire of losses, and they are designed to protect the speculator from his own human weakness. Rules for position sizing, for the cutting of losses, for the pyramiding of a position. These are the tools of a fallible man who respects the market's power to inflict ruin. But the speculator who now feels infallible begins to see these rules as a set of crutches that he no longer needs. They are for the amateurs, for the novices, for the man he used to be. He is a genius now, and a genius can trade on inspiration alone. He begins to take larger positions than his own scientific formula would dictate. He is no longer risking a small, calculated fraction of his capital. He is making massive bets, confident that his judgment cannot be wrong. He becomes lax with his stop losses. He holds on to a small loss, believing his genius will be vindicated and the trade will turn around. He begins to make exceptions to his own ironclad laws, telling himself that this time is different. He has forgotten the most crucial lesson of all, that on Wall Street, the moment a man believes that this time is different, he has already paid for the expensive lesson that will soon teach him it is not. The third symptom of this disease of success is a change in a man's fundamental desire. The desire that drove his successful campaign was a definite and specific one, to profit from a single, well-analyzed market move. Now with a great fortune in his pocket, a new and more dangerous desire takes its place. It is the insatiable hunger for more. A great profit does not satisfy a man. It often only whets his appetite for an even greater one. The desire to make $1 million is instantly replaced by the desire to make 10 million. This new desire is not a calculated, strategic one. It is a raw, emotional, and greedy one. The speculator is no longer content to be a patient hunter, waiting for the next perfect opportunity to present itself. He now feels the need to force the action, to make something happen, to keep the game going at all costs. He begins to see potential trades where none exist. He mistakes the minor, meaningless fluctuations of the market for the beginnings of a new, great swing. His judgment is clouded by his own insatiable greed. He has forgotten that the great, profitable moves are rare. They are the exception, not the rule. He begins to treat the market like a personal ATM, believing he can withdraw a fortune from it whenever he pleases. The market will soon disabuse him of this notion. This entire tragic cycle was perfectly illustrated in Livermore's own career after his monumental success in the panic of 1907. He emerged from that crash a legend, the great bear of Wall Street, a multimillionaire who had proven his genius to the entire world. He was at the absolute peak of his powers and his confidence, and it was this very confidence, this hubris, that led him directly and swiftly to his next great ruin in the cotton market. He felt the need to conquer a new world, to prove that his genius was not confined to the stock market. He would become the cotton king. He began to build a position in cotton that was, by any rational standard, recklessly and dangerously large. He was no longer a speculator, carefully probing the market and managing his risk. He was a would-be emperor, attempting to corner...
Yep, break 50, guys, break 50!
...his own capital and his own will. He was not trading the market, he was trying to be the market. This brings us to another subtle and...
Right there, resistant right there.
Success.
But the volume look good.
Great fortune and great fame attracts the attention...
The volume look good.
He is invited into the inner circle, into the boardrooms and the private clubs. He is no longer a lone wolf, but a member of a prestigious pack. This can be a fatal development for a speculator. His great strength has always been his intellectual independence, his reliance on his own unfiltered reading of the tape.
Right here, look good right here.
His mind is exposed to the persuasive
40 support, break right there, nice ball blast.
This is precisely what happened to Livermore in the cotton market. He was seduced by the charismatic and powerful personality of the cotton expert, Percy Thomas. He allowed his own judgment to be subordinated to the grand vision of his new influential friend. The successful speculator begins to believe in the myth of his own genius, and this makes him
look at that guy. Put down real hot, huh?
Plans of others who seem to be of his own stature. He has forgotten that on Wall Street there are no friends, only interests.
Right there, look at that guy. Look at us.
The seduction of success is a subtle perversion of the desire to win it back.
Short right there, guy.
This is not the familiar desire of a loser trying to recoup a loss.
That's crazy, huh?
Of a winner who, after long and
learn how to sell, guy. Learn how to sell.
Normal setback and reacts to it with a sense of personal affront. The speculator has built a massive position. The market
learn how to sell.
Healthy reaction, and his enormous paper profit shrinks by a few percent. The amateur who has been humbled by failure might see this as a warning, a signal to take some profits off the table. But the man who has been intoxicated by his own success sees it differently. He feels that the market has stolen a piece of his new and glorious fortune. His ego is wounded. He is not driven by fear, but by a prideful and aggressive desire to not just win back that small lost ground, but to punish the market for its impertinence by winning even more. This is the psychological trigger for the most fatal of all mistakes. It is what causes a man to hold on to a normal reaction that is turning into a major reversal. It is what causes him to average down his winning position, a subtle but deadly error.
Hey, have you guys see what's going on? Look at this.
It is in these moments of
guys see right there, resistant, squeeze. Crazy, huh? Every day, guy, every day like this.
The emotions after a great victory are, in many ways, far more dangerous than the emotions after a defeat. It is for this reason that a constant return to the first
crazy pull back 250 squeeze again,
but an absolute necessity for his survival.
Every day, guys.
To this channel, to this video and others, especially in the euphoric aftermath of a successful trade, serves as a vital cold water shock, a recalibration of the mind to the professional state of eternal vigilance. The inevitable consequence of all these symptoms, the loss of humility, the abandonment of rules, the insatiable greed, and the prideful refusal to accept
this is a nice setup right here, Greg.
And tragic unraveling.
Nice setup.
The speculator, having made himself vulnerable through his own success, is now perfectly positioned for his next great ruin. He is over-leveraged, his position is too large, his mind is clouded by ego, and his discipline has been relaxed. He is a giant with feet of clay. The market does not need to do anything extraordinary to destroy him. All that is required is for it to do what it always does, to fluctuate, to have a normal, healthy, and entirely predictable major reaction. But for the speculator who is now in this weakened and overextended state, this normal reaction is a catastrophic event. It triggers a margin call. It forces him to liquidate his massive position into a declining market, which accelerates the decline. The fall is always faster, more brutal, and more shocking than the long, slow climb. The fortune that took a year of brilliant speculation to build can be wiped out in a matter of days or weeks of undisciplined emotional trading. This, then, is the first half of the great lesson on the seduction of success. It is the diagnosis of the disease. It is the anatomy of how a great victory can become the direct and
crazy guy, look at that. That's a nice chart.
Success is a more dangerous.
I told you VVS setup, guys, right here. The VWAP.
Tonic that teaches caution and humility.
The VWAP right there.
A sweet poison that breeds arrogance, recklessness, and a fatal sense of infallibility. The emotional traps that are sprung by a great and triumphant.
Let's see what's going on with this one.
Enemies of the speculator. They are more dangerous than any bear raid or market panic, for they are an enemy that comes from within. The man who wishes wishes to achieve a long and sustained career in the great game of speculation must learn not only how to make a great deal of money, he must learn the far more difficult and more important art of how to handle the psychological aftermath of having made it. If the seduction of a great success is the most subtle and dangerous poison on Wall Street, then the only antidote is a cold, hard, and deliberate dose of intellectual discipline. The speculator who has been fortunate enough to win a great campaign is now faced with his most difficult test. The market is no longer his primary adversary. The new enemy is his own triumphant and therefore dangerously unreliable mind. The professional understands this. He knows that the moment of his greatest victory is also the moment of his greatest vulnerability. He must
Look at that guy.
engage in a conscious and systematic
What do I say?
self-control, a series of mental and practical actions designed
What do
to
I say,
mitigate
guy?
the
What do I
toxic
say?
effects of his own success. This is the science of
Right
handling
there.
fortune.
See my line right
This is
there?
not a matter of
Important,
guesswork
guy.
or of hoping for the best. It is a definite method, a set of
The
principles
line right
that
there.
he treated as necessary as
Very
he
important.
guided his trading during the campaign itself. To abandon these principles at the moment of victory is to guarantee that the victory will be a temporary one. Let us then dissect this method. Let us examine the
Look right here.
specific,
Open.
practical,
Open
and
down.
psychological steps that a master speculator must take in the immediate aftermath of a great and profitable move. This is the art of not just making a fortune, but of keeping it.
See, $3-4
The
easy.
first and most critical act that a wise speculator performs after closing out a major winning position is not to indulge in lavish celebration, but to conduct a cold and unemotional audit of the entire campaign. He must become a ruthless historian of his own success. He will take out his trading records, and he will study them with the same intensity with which he once studied the tape. He will ask a series of hard questions. What precisely did he do right? Was his timing at the pivotal point perfect, or was he a little early or late? Was his pyramiding strategy sound, or did he become too top-heavy at the end? He must also, with brutal honesty, analyze the role that luck played in his success. Was there a fortunate news event that accelerated his profits? Did he benefit from a market that was even stronger than he had anticipated? He must separate the results of his skill from the results of pure, dumb luck.
Try to dumb right now.
Post-victory audit is an act of
Try to dumb right now, guy.
humility. It is a deliberate exercise designed to counteract the ego-inflated
$30.
of the win. It reinforces the critical understanding that his success was the result of following a sound method, not the result of some mystical inborn genius.
Crazy,
The second
huh?
act is the conscious and deliberate preservation of
VWAP, guy.
equity.
VWAP.
The speculator must constantly remind himself that the market is always the master.
Right here, the VWAP right
Always
now.
will be its humble student. His great success was not a sign that he has conquered the market, but merely a sign that during that one campaign he was a very good and attentive student. To achieve this, he must engage in a form of mental counterbalancing. He must, in the midst of his great success, deliberately recall the memory of his past, painful failures. He must remember the times when he was wrong, when his judgment was flawed, when the market humbled him completely. He must study the history of the market and the lives of other great speculators, paying particular attention to the stories of their downfalls. He must see in the failures of others a cautionary tale.
Short, try to short at the VWAP.
This is not a morbid exercise, it is an act of profound realism. This practice keeps his mind grounded. It prevents the temporary feeling of infallibility from hardening into a permanent and dangerous state of arrogance. He knows that the market is always waiting to humble the man who has forgotten his place in the great scheme of things. The third act, which flows directly from the first two, is the immediate and fervent reinforcement of his own trading rules. The amateur, flush with victory, believes he has transcended the need for rules. The professional knows that this is the moment when the rules are more important than ever. The speculator who has just won a great fortune must, at that very moment, take out his written list of principles, his rules for risk management, for position sizing, for entries and exits, and he must read them as if for the first time. He He must make a new and solemn vow to himself that he will adhere to these rules on his very next trade with the same rigid discipline he used when he was starting out with a small and precious stake. He must commit to treating his next opportunity as if it were his first. This is a powerful act of mental discipline. It is a recognition that the principles of sound speculation are universal and unchanging. They apply to the man with $10 million, just as they apply to the man with 10,000. To believe oneself exempt from these laws is the very definition of a fool. The fourth act is a practical one concerning the management of the new, larger capital base. A great profit brings with it a great new responsibility. The speculator's capital has now grown, and he must adjust his thinking accordingly. The amateur, having turned $10,000 into $100,000, may see this new fortune as house money. He may feel that it is money he can afford to be reckless with, to gamble on a long shot. This is a fatal error in thinking. The professional understands that there is no such thing as house money. It is all his capital. The new, larger fortune must be treated with even more reverence and respect than the original, smaller stake. For it is the fruit of a successful campaign, and it is the ammunition for all his future operations. He must adjust his risk.
This is a classic right here, guys. Look here at the top. Touch right there, start go down. VWAP right here, the VWAP. When you break here, go lower. When you break here, you see the moon, okay? That's all. That's all, guys. Look here. Top. Top. Underneath here. Short in control. Break here. Short got squeeze. Squeeze here, guys. Squeeze.
And perhaps most important practical act after a long and grueling
short control right here.
Withdrawal.
You need to get out right here underneath here.
This position and converted his paper profit into cold hard.
That's it.
Does not immediately look for the next trade. He does the opposite. He gets up from the desk and he walks away from the game entirely. He takes a vacation. He goes fishing. He travels. He does anything and everything that is completely unrelated to the stock market. He forces himself into a period of quiet, restorative inactivity. The purpose of this is to allow the mental and emotional intoxication of the great victory to fade. The human nervous system is not designed to exist in a permanent state of high stakes, high adrenaline excitement. It must be given time to rest, to clear, and to return to a state of calm, objective normalcy. To remain in the market in the immediate aftermath of a great win is to guarantee a reckless, emotional, and almost certainly losing trade. The speculator is, in that state, not operating with his intellect, but with his overinflated ego. He must wait for his head to clear. This strategic withdrawal is an act of profound self-knowledge. It is a recognition that a man's own triumphant emotions are, at that moment, his greatest and most dangerous enemy. The sixth act occurs when the speculator, his mind now clear and his nerves settled, finally decides to return to the market. He does not return with a great and dramatic flourish, with a massive bet designed to prove that his genius is still intact. His very first trade, even as a multi-millionaire, must be the same as it was when he was a novice with a tiny stake. It must be a small, cautious, and exploratory probe. This is the ultimate test of his discipline, the final proof that he has not been permanently corrupted by his own success. It is an act of profound humility. He is once again a humble student, asking the market a quiet question, not a master shouting a command. He waits for the market to give him a clear signal at a pivotal point. He makes his small test trade. He waits for the market to confirm his judgment with a profit. He is following the same methodical scientific process that he has always followed. He has returned to the fundamentals. By starting small again, he re-engages with the market from a position of mental and financial safety. If his first few trades back are small losses, they are of no consequence to his great fortune. They are simply the market's way of telling him that the time is not yet right. The seventh act of discipline is the resistance to the temptation of new and unfamiliar fields. A man who has achieved a great success in the stock market often begins to believe that his genius is universal. He is seduced by the idea that he can apply his Midas touch to other, more glamorous ventures. He will be tempted to take his speculative winnings and invest them in real estate, in venture capital, in oil exploration, or in the manufacturing of a new invention. This is a classic and often fatal error. The principles of success in one field do not automatically translate to another. The world is filled with the stories of brilliant stock speculators who lost their entire fortune by venturing into businesses that they did not understand. The professional, having won the game he has mastered, has the wisdom to stick to that game. He knows where his expertise lies. He does not allow his ego to convince him that he is a universal genius. He respects the specialized knowledge that is required for success in any field. The eighth act is the battle against the great and terrible enemy that often follows a major success: boredom. The thrill of the great campaign is over. The market itself may enter a dull, listless, sideways period where no clear opportunities exist. The undisciplined speculator, now a man of great wealth and with a mind that is addicted to excitement, finds this state of quietude to be unbearable. He craves the old thrill, and so he will begin to force the action. He will make foolish trades in a dead market, not for the profit, but for the gamble, for the simple desire to feel something. He will invent opportunities where none exist. This is the path back to ruin, a slow bleed of capital caused by a lack of emotional control. The professional, by contrast, accepts the periods of dullness as a necessary and even welcome part of the market cycle. He has the discipline to sit patiently in cash, to read, to study, to rest his mind, and to wait. He knows that he is not paid to be entertained. He is paid to be right. And being right often requires long periods of doing nothing at all. This brings us to the final and most profound understanding. The true victory of a speculator is not the accumulation of the great fortune. That is merely the scoreboard. The true victory is the ability to keep that fortune not just financially but psychologically. It is the ability to handle a great and triumphant success without being inwardly destroyed by it. It is the victory of character over ego. It is the triumph of discipline over emotion. It is the quiet and often lonely work of remaining a humble student in the face of a world that is calling you a master. The speculator who has learned how to do this, who has created a definite method for managing not just his capital but also his own triumphant human nature, is the one who has achieved the highest and most difficult level of the game. He has conquered not just the market, but the far more treacherous and unpredictable landscape of his own mind. He has learned that failure is a teacher, but that success is a test, and it is by far the harder one to pass.
Yep, under the rewrap, guy, under the rewrap.
Fraction of the speculator's total capital base.
Look right there, under the rewrap.
More than 1 or 2% of one's total fortune on a single speculative idea. This is the mathematical guarantee of survival. A speculator who follows this rule can be wrong
Under the rewrap right there,
and still only have lost 10 or 20% of his capital.
Look at this one, keep
He's
going
still
higher.
insane. He is still a factor. The amateur who was wrong just once on his big, reckless bet is out of the business forever. This rule is the source of true speculative courage. A man who knows that the maximum possible loss from any single trade is a small and manageable amount is a man who can trade without fear. His mind is free from the paralyzing anxiety that comes from having too much on the line. He can make clear, objective decisions based on the evidence of the tape, not on a desperate need to protect himself from a ruinous loss. It is in these moments of calculating risk and managing exposure that the true
Under the rewrap
is done. The emotional desire to bet big is a powerful enemy.
See this here right
There's
here.
reason that a constant return to these first principles is
Look like this guy, look at this.
a return to this channel. To this
One more
taking
chain,
others,
support right here.
especially after a series of painful
Under
losses
29.
of one's judgment.
Be
serves
careful.
as a vital recalibration of the professional mindset. The science of position sizing is
Under
the
29, be
important
careful.
element of a sound defensive strategy. The man who masters it has made it mathematically impossible for the market to ever deliver a fatal blow. He has guaranteed his own survival, which is the first and most important victory in the great game. 7. Wait for clear market signal. The great game of speculation is not a game of action, but a game of reaction. The amateur, driven by his impatience and his greed, is always trying to make something happen. He seeks to impose his will upon the market. The professional knows this is a fool's errand. He waits with the calm vigilance of a master for the market itself to give the signal. A speculator is not paid to be a fortune teller. He is not paid to anticipate, to guess, or to hope what a stock will do. He is paid to correctly diagnose the present fact of the market's action and to act upon it with intelligence and dispatch. To act before the market has spoken is to be a gambler, betting on a blind turn of a card. The clear market signal, the one that justifies the risk of one's capital, is the breakout at a pivotal point. This is the moment when a stock, after a period of consolidation, decisively announces its intention to begin a new and powerful move. This is the moment when the line of least resistance becomes clear and unmistakable. This signal must have a definite character. It must be a move of authority, a breakout with power and force, and it must, without exception, be accompanied by a dramatic and significant increase in the volume of trading. This is the market's own confirmation that the move is genuine and is being sponsored by the smart money. To buy before this pivotal point is to act on hope. To buy after this pivotal point has been confirmed by the tape is to act on evidence. The entire science of speculation can be reduced to this simple distinction. The professional waits for the evidence. He may have to wait for days, for weeks, or even for months. It does not matter. He has the discipline to sit with his capital and his peace of mind intact until the one single high-probability moment presents itself. The market is not a continuous performance. It is a series of rare and valuable opportunities. The speculator's job is to be ready for them. To act without a clear signal from the tape is to be a sucker, providing your capital for the benefit of those who are patient enough to wait for the proper time. 8. Cash is a position. The amateur speculator believes that to be in the market is to be a speculator, and to be out of the market is to be a failure. He feels a constant nervous itch to be invested, to have a position on. To be in cash to him feels like an admission of defeat, a missed opportunity. This is a profound and costly psychological error. The master speculator understands a truth that is invisible to the novice. The cash position is often the most strategic, the most powerful, and the most profitable position of all. To be in cash is not to be out of the game. It is to be a king in reserve, waiting for the decisive moment to enter the battle. The man who is in cash possesses an asset of incalculable value, a clear and objective mind. He is not emotionally entangled in any particular stock. He is not being whipsawed by the market's minor fluctuations. He is not suffering from the mental exhaustion that comes from a series of small, frustrating losses. He can sit and observe the market with the cool detachment of a scientist. He can see the great primary trends forming without the distorting lens of his own hopes and fears. His judgment is sound. His mind is at peace. The man who is always in the market, by contrast, loses his perspective. His judgment becomes clouded by his last trade. He is either overconfident from a small win or fearful from a small loss. He cannot see the forest for the trees. There are long periods in the market when the conditions are not clear, when the tape is telling a story of confusion and indecision. These are the treacherous sideways markets. The professional speculator knows that to trade in such a market is to engage in a low probability gamble. His response is simple. He does nothing. He sells his positions, converts his assets to cash, and he waits. He preserves his capital, and more importantly, he preserves his mental and emotional energy. He knows that his job during these times is to study the market, not to trade it. To be in cash is to be the master of your own destiny. You are not at the mercy of a sudden overnight news event. You are not a prisoner of your own position. You are a free agent with your capital intact, ready to strike with overwhelming force when the one true and unmistakable opportunity finally presents itself. 9. Never trust tips or other people's opinions. The speculator who would succeed must learn to stand alone. He must be a lone wolf, doing his own thinking, forming his own conclusions, and acting upon his own judgment. The moment he allows the opinion of another man to influence his decisions is the moment he has surrendered his own mind, and his capital is sure to follow. The world of Wall Street is a vast and noisy echo chamber of tips, of rumors, of so-called inside information. This is the bait for the sucker. The amateur, in his intellectual laziness and his desire for a shortcut to easy money, is an insatiable consumer of these tips. He does not stop to ask the most logical of all questions. If this information is so valuable, why is it being given to me? He does not see that a genuine tip is the rarest thing in the world, and that the vast majority of what he hears is either a guess, a hope, or a deliberate piece of manipulative propaganda. To act on a tip is to make a trade for which you do not understand the premise. You do not know the real reason for buying, and therefore you will never know the real reason for selling. You are a blind man being led by another and both are destined for the ditch. Livermore learned this lesson in the most brutal way possible. In the great cotton debacle where he lost a fortune by subordinating his own judgment to that of the expert Percy Thomas. He had seen the cell signal on the tape. His own proven method was screaming at him to get out. But he listened to the persuasive, hopeful words of another man. It was a mistake that cost him everything. From that day forward, the rule was absolute. He did his own work. He studied his own charts. He read his own tape. His mind was a locked room, and the opinions of other men were not granted entry. The speculator must learn that no man can make a great fortune by having another man tell him what to do. The thinking must be his own. The decisions must be his own. And the responsibility for both the profits and the losses must be his own. 10. Patience is protection. The virtue of patience is not, as the amateur believes, a passive quality. It is an active and powerful form of defense. It is the speculator's primary shield against the two things that are most certain to destroy him: his own emotional impulses and the market's many deceptions. Patience is the discipline to wait, motionless, for the one true high-probability setup. It is the refusal to be lured into the market by the siren song of small, meaningless fluctuation. It is the wisdom to know that the money is made not in the trading, but in the waiting. Patience is the protection against the whipsaw of a sideways market. The impatient trader is chopped to pieces, his capital bled dry by 1,000 small cuts. The patient trader stands aside in cash, his capital preserved, and waits for the trend to declare itself. Patience is the protection against chasing a stock that has already had a great and powerful advance. The impatient trader, driven by a fear of missing out, will rush in at the top, just as the smart money is beginning to sell. The patient trader will let the stock go, knowing that to buy late is to buy wrong. He understands a simple truth. The market is a continuous parade of opportunities. To miss one is of no consequence, for another will soon come along. There is no need to be in every mood. There is only a need to be in the right moods. Patience is also the courage to sit tight with a winning position. It is the discipline to not be shaken out by the normal, healthy reactions that are a part of every great trend. It is the fortitude to let a profit run, to allow a 10-point gain to become a 100-point gain. The speculator in the end is paid for his patience, He is paid for his patience in waiting for the correct entry. And he is paid for his patience in waiting for the correct exit. Every other action in between is a potential source of loss. 11. The market is always right. A speculator is a man who deals in opinions. He forms an opinion based on his study about the future direction of a stock or the market. But he must never, for a single moment, forget this one supreme and humbling truth. His opinion is worthless until it is confirmed by the market itself. The ticker tape is the final arbiter. It is the Supreme Court. Its verdict is the only one that matters. The speculator who begins to believe that his own opinion is more important than the market's action is a speculator who is on the verge of a great and devastating ruin. This is the very essence of the ego trap. The amateur, when a trade goes against him, is often heard to say, "The market is wrong. This stock should be going up." This is a statement of profound and dangerous insanity. The market can never be wrong. It is the sum of all forces, all knowledge, and all opinions. It simply is. The speculator's opinion, on the other hand, can be, and very often is, wrong. The entire business of risk management is built upon this simple acknowledgement of one's own fallibility. The stop loss is the practical mechanism for enforcing this principle. It is the pre-committed decision to accept the market's verdict without argument. When a stock moves against a speculator and hits his stop, the market is saying, "Your opinion is wrong." The speculator's only sane response is to say, "I accept your verdict," and to close the position. To argue with the tape, to hold a losing position in the face of the market's contrary evidence, is the act of a man whose pride has become more important to him than his capital. And the market has a way of taking both from such a man. 12. Control emotions. This is the final and the all-encompassing law. It is the one principle that makes all the other 11 possible. The speculator who has not first learned to control himself can never hope to control his account. The great battle is not fought on the exchange. It is fought within the mind. The market is a machine that is designed to exploit the most powerful and primitive of human emotions. It tempts a man with greed. It paralyzes him with fear. It deludes him with hope. It inflames him with ego. These are the great enemies of the speculator. The entire set of rules and principles that Livermore developed was, in the final analysis, a system for the management and control of these emotions. It was a scientific fortress, built to protect his rational, analytical mind from the destructive chaos of his own human nature. The stop loss is a rule against hope. The practice of patience is a rule against greed and impatience. The principle of following the trend is a rule against ego. Each rule is a specific and targeted defense against a specific emotional weakness. The speculator who would succeed must become a cold and detached operator. He must learn to view the market not as an exciting casino or a personal antagonist, but as a series of impersonal mathematical problems to be solved. He must achieve a state of mind where he can take a loss without flinching and a great profit without gloating. He must be a scientist, an observer of facts, not a participant in a great emotional drama. This is the hardest work of all. It is a lifelong and never-ending battle against the powerful currents of one's own inner world. But it is the one battle that must be won. For the speculator who has achieved a state of perfect emotional control is a speculator who has at last become invincible.
Most people believe great traders are born with a gift. They imagine a sharp mind and natural instinct, some secret ability that lets them read the market like an open book. But the truth is far more brutal and far more inspiring. The traders who rise to the top, the ones who make millions and stay there, are not the ones who escape pain. They are the ones who walked through it, bled from it, and came out sharper because of it. Mark Minervini's story is not one of comfort. He didn't inherit an edge. He didn't begin with some hidden advantage. What he began with was failure, frustration, and scars. And those scars became the very foundation of his strength. Every setback cut him deeper, but every cut taught him a lesson. While most people search for shortcuts, Minervini endured the long road, the kind where you lose money, lose confidence, and wonder if you'll ever make it out. That road didn't just test him.
One day I want to ace my serve. One day I want to fill my passport.
Next!
One day I want to nail my skincare routine, so I make healthy choices and take a multivitamin designed for women. One a day is the multivitamin designed for every woman's one day. We're here for you. Science that matters for nutritional support. Grab your one-a-day vitamins at your favorite retailer today.
It trained him. There's a paradox at the heart of his journey. The same struggles that nearly broke him were the struggles that shaped him into a world-class trader. Without them, he wouldn't have had the discipline. Without them, he wouldn't have had the obsession. Without them, he wouldn't have had the edge. This is the part most traders miss. Struggle isn't a detour on a path to success. It is the path. It's not something to avoid, but something to embrace. Because inside, the pain lies the lesson that will set you apart. And so, when Minervini says struggle makes you stronger, he isn't offering a motivational slogan. He's describing the very curriculum of mastery. Struggle was his teacher. Struggle was his training ground. Struggle was the fire that forged him. Part 1. The Empty Bank Account Test. The first test every trader faces isn't the market itself. It's survival. For Mark Minervini, that test came early, and it came hard. He wasn't handed capital to cushion his mistakes. He wasn't given a lifeline when things went wrong. Instead, he had to watch his account bleed down to almost nothing. That empty balance wasn't just numbers on the screen. It was a mirror reflecting a harsh truth. The market doesn't care who you are, how much you want it, or how many hours you study. It only cares about your ability to adapt. For most people, financial struggle is the end of the story. They lose, they get burned, and they walk away convinced that trading is a rigged game. But for Minervini, that moment of staring at a near-empty account wasn't the end. It was the beginning. He realized something most traders never do. When money is scarce, clarity becomes your only ally. Every decision matters. Every mistake carries weight. There is no luxury to trade carelessly when the margin between survival and failure is razor thin. Struggle forces focus. When you have little left, you stop chasing every shiny setup. You stop gambling on tips and winners. You begin to listen, really listen, to what the market is telling you. And the market speaks only one language: price and risk. That's when the noise begins to fall away.
Mazda? Once you discover the Mazda CX-5, Mazda, it doesn't take long to get it. With standard all-wheel drive, a premium interior, and advanced safety features, it's an SUV that gives you more at every turn. What do you say? Mazda. Mazda CX-5. It's made to move you.
Every Mazda SUV offers you an elevated driving experience and refined performance. Discover it at your local Mazda dealer today.
Minervini has said that losing nearly everything gave him something more valuable than money. It gave him discipline. It gave him the kind of sharpness that only comes from standing on the edge and realizing you can't afford another slip. Without that early financial pain, he would have gone on trading recklessly, wasting years in denial. But the empty account was a brutal teacher. It demanded he get serious or get out. The market is merciless, but it is fair in one way. It gives feedback. Every dollar lost is a lesson. Every blown trade is a signal. Every margin call is a warning flare. Most ignore those signals. Minervini didn't. He took the lesson to heart. Excuses don't pay bills, and hope doesn't refill an account. Action does. Precision does. Adaptation does. That's why his story resonates with traders today. Because while the details may differ, the test is universal. Maybe you felt get that same pit in your stomach as your account shrinks. Maybe you've wondered if you'll ever recover. That feeling is the very pressure that can forge clarity if you let it. For Minervini, the empty bank account wasn't the end of his trading career. It was the crucible that burned away illusions and left only one path forward. Learn the rules, respect the risk, and take the market seriously. The struggle stripped away comfort, and what remained was the discipline that would eventually build his fortune. Part 2. Psychological battles. Fear, shame, ego. If losing money hurts, losing confidence can destroy you. Numbers on a screen can sting, but it's the emotions behind those numbers that break most traders. Struggle doesn't just drain your bank account. It drags your mind into battle with forces far stronger than any chart pattern. Fear, shame, ego. These are the invisible enemies that finish the job the market starts. For Mark Minervini, the early years weren't just a financial test. They were an emotional gauntlet. Every loss whispered the same question in his ear. Are you good enough for this? Fear grew louder with every trade. Fear of pulling the trigger. Fear of losing more. Fear of looking foolish for trying at all. And then there was shame. The shame of telling friends or family that you lost again. The shame of sitting in front of a screen for hours, only to walk away with less than you started. Shame eats at a trader's confidence like rust. It doesn't just remind you that you failed. It convinces you that you are a failure. But perhaps the deadliest opponent of all is ego. Every trader carries it. The belief that you're smarter than the market. The need to prove that your idea is right. Ego turns a losing trade into a war. Instead of cutting losses, you double down. Instead of admitting you're wrong, you cling to hope. And the market punishes ego without mercy. Struggle has a way of dragging all these weaknesses into the light. It doesn't let you hide behind theory. It forces you to face the truth. You are not battling the market. You are battling yourself. Minervini has often described how much of his journey wasn't about finding the right stock, but about stripping away the emotions that cloud judgment. Only after facing fear, shame, and ego head-on could he see the market with clarity. This is why so many never make it. They can survive a few losing trades, but they can't survive what those trades do to their identity. Minervini did, because he understood that those emotional scars weren't disqualifications. They were part of the curriculum. Struggle doesn't just expose weakness. It also gives you the chance to strengthen what was once fragile. Fear can be turned into respect for risk. Shame can be turned into humility. Ego can be tempered into discipline. Without those psychological battles, Minervini wouldn't have had the foundation to master the market. Part 3. Learning without a safety net. Today, traders have endless resources at their fingertips. YouTube tutorials, trading forums, podcasts, entire communities ready to share strategies and shortcuts. But when Mark Minervini started, none of that existed. There were no easy down roads, no step-by-step guides, no safety net to fall back on. He had to carve out his edge the hard way, through trial, error, and often painful loss. In many ways, that lack of guidance became his greatest advantage. When you don't have someone to hold your hand, every mistake carries real consequences. You can't shrug off the loss and assume someone else will explain it to you later. You're forced to figure it out yourself. That pressure accelerates learning, because survival depends on it. Minervini's school was the market itself. Every trade was a lesson. Every failure was feedback. And the tuition he paid wasn't theoretical. It was money leaving his account. That reality has a way of sharpening the mind. Unlike a classroom, the market punishes ignorance instantly. It doesn't wait for you to catch up. You either adapt or you get eliminated. Without a mentor, he had no choice but to become his own. He built notebooks of observations, studied charts obsessively, and questioned every decision until he began to see patterns emerge. It was lonely work. There was no one to reassure him, no group to celebrate wins with or soften the sting of losses. But that solitude forced a kind of independence that most traders never develop. When you rely too heavily on others, you inherit their blind spots. You adopt their biases. choices. You start trading someone else's conviction instead of your own. Intervening avoided that trap by necessity. The struggle forced him to build his convictions from the ground up, tested and hardened against the only measure that mattered: results. Looking back, he often emphasizes that the pain of learning alone was also the power that shaped his discipline. When there's no safety net, you respect risk more. You pay attention more. You stop gambling and start observing. Struggle demands accountability, and accountability builds mastery. It's tempting to think that an easier path would have been better, that a mentor or a community could have saved him time. But easy paths rarely build lasting strength. Intervening's independence became his edge because it was forged in necessity. He didn't copy someone else's system. He built his own, brick by brick, out of hard-earned lessons that could never be taken from him. And that's the paradox of struggle. The lack of a safety net feels like a curse, but in hindsight, it's a gift. It forces you to grow stronger than you thought possible, to trust your own eyes, and to rely on your own judgment. For Intervening, those early years of isolation weren't wasted. They were the crucible in which his trading identity was born. Part 4. Obsession born from pain. Every trader starts with curiosity. The charts look exciting, the profits seem possible, and the dream of freedom glows brightly. But for Mark Intervening, curiosity didn't last long. The market stripped it away, replacing it with something much heavier: failure, disappointment, and loss. And it was inside those failures that something unexpected happened. What began as casual interest turned into a relentless obsession. Pain is a way of forcing a decision.
Life doesn't wait, and neither should you. A lead can help you deal with pain less throughout your day. Whether it's a long day on your feet, a demanding workout, or everyday aches and pains, you need relief that can keep up when pain persists. Aleve is here for you with longer-lasting body pain relief, compared to leading OTC-branded pain relievers. With just one pill, Aleve lasts up to 12 hours. Don't let those aches hold you back from doing what's important to you. Use as directed.
For many, the pain of losing money ends their trading journey. They take the hit, shake their heads, and walk away. But for Intervening, each failure didn't close the door. It pushed him deeper. Every time he got knocked down, his hunger grew sharper. Struggle didn't weaken him. It lit a fire. He stopped treating trading as a hobby, because hobbies can survive with half-hearted effort. This wasn't weekend entertainment anymore. It was survival. It was identity. It was the challenge of a lifetime. He began pouring hours into studying patterns, replaying trades, dissecting his mistakes until the answers began to emerge. The market became an opponent he refused to let defeat him. This is a transformation all serious traders must face. Pain strips away the casual dreamers, leaving behind only those who can't walk away. Intervening was one of them. Every loss was a reminder that he had more to earn. Every failure was fuel for the obsession to master the game. Where others gave up, he doubled down, not with reckless bets, but with relentless commitment to learn the truth behind price action and risk. Think of the great breakthroughs in your field. Rarely are they born from comfort. They are born from a mind that cannot let go. A mind so consumed by the problem that the solution eventually reveals itself. Intervening's obsession was forged in that fire. He no longer asked, "Can I make money trading?" The question became, how can I master this craft so deeply that the market itself...
And under 29, I told you
That
guys.
shift, trading from curiosity to trading from obsession, was one of the pivotal changes in his journey.
Hey, lazy Vic. Under 29,
What
huh?
was left was a fierce determination to turn struggle into mastery. And that obsession, once born, never let him go. Part 5. The discipline of scarcity. Nothing sharpens discipline like scarcity. In the early years...
But be careful, after our break 35, you will see the mood.
Could absorb mistakes. He was operating on fumes. And when you're trading with limited capital...
Look right here, look at that guy, look at this, see?
For your account. Scarcity has a way of cutting through illusions.
Under 30 right here, boom. You guys see that? Under 30, pull back, right here. 32 right here, pull back, all the way down, become resistant right here. That's crazy, guy. That's crazy. It's okay. You wait right here, guy. Waiting. You wait right here. Wait and see. Wait and see, guy. 28. Wait and see.
He cut losses quickly because holding on to them was fatal. He only entered trades when conditions were stacked in his favor because one mistake could erase weeks of progress. He needed to wait and be selective and treat trading like surgery rather than gambling.
Wait and see, guy. Right here. Wait and see right here.
Became the foundation of his strength. Scarcity created
Resistant 32. Right here. Look at it. Right here, 32. Crazy.
His habits were already forged in fire. He didn't loosen up just because he had more capital.
Come up to 32, pull back.
The same precision.
Maybe try.
This is why so many traders misunderstand the gift of starting small. Scarcity feels limiting, but in reality, it builds the muscles that abundance tends to weaken.
Maybe try right here. Boom, boom, boom.
See this small account as an excuse.
Right here, support.
And he built the discipline that later allowed him to trade with size. In the end, scarcity wasn't his disadvantage. It was his edge. Part 6. Risk management as survival.
Boom, 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 boom.
Discipline. Struggle taught him the deeper law of survival. Risk management isn't optional. It's the oxygen of trading. In his early years, he didn't have the luxury of ignoring this truth. Every trade carried the possibility of ending his journey. That pressure forced him to see risk not as a technical concept, but as the single most important principle of staying alive in the market. Most traders enter the game dreaming big.
Alright, right here, another support right here. When they break the VWAP, be careful. A flush it up when they break the VWAP. Underneath, go lower.
The difference sounds simple.
Everything can happen, guys.
It was everything. Without the ability to cut losses quickly, no trader survives long enough to see the.
Alright, that's it. See you guys later.
Holding losers wasn't just emotional draining, it was financial suicide.
Look at this one. Keep going higher. Look at it. Keep going higher.
Over time, he realized that survival meant treating every position with ruthless clarity. The question wasn't, will this trade make
How about laser?
The question was, how much am I willing to risk if it
Laser all the way down.
That shift became the core of his philosophy. He wasn't trying to eliminate risk. He knew that was impossible. Instead, he mastered controlling it. He sized his trades so no single position could knock him out. He put.
Alright, guys. Any question? I got my dinner, lunch already, so. Breakdown hot. Bear plus. Double top right here, boom, down. Deep buy? No. This one not deep buy. You don't do deep buy, okay? That means call every down. Not the deep buy. It's the back side. You're on down. It's going down, so don't touch it. You want to buy 35 right here. The VWAP. The VWAP right here, guys, right here. You buy right there. Break VWAP, you buy. If not, become resistant. Start to go down all the way down here to $20. $20, guys, 20. Go down all the way here, 20. Right here. The support right here. You want squeeze, you can buy here or buy here. It's all the way down, okay? Boom, 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 boom. See how low can it go? Don't know yet. Don't know, okay? Don't know yet. Let the market tell you how low can it go. Let the market tell you. I think maybe 20. And this one can squeeze tomorrow. You never know. A lot short right now. A lot short right now. How low can it go? Right here, guy. Right here. There's a classic right here, you see? So right here, bear cloth. I see bear cloth. Bear cloth. Classic bear cloth. You guys see that? It's not going up, okay? Your eye can see it. Your eye see it go down. Your eye see it go down. Your brain think it go up. You said buy cheap, deep buy. Nah, no deep buy, nothing. It's not going up. Not going up yet. Open 25. You need to break 35, so if you go higher, 35. Yep.
Lỗ. Nó đậu lên, nó đậu, nó đồng hành mấy hàng bảy không?
Chưa có tin tức mà. Đâu có dễ lên đâu.
Nhẹ nó anh tỷ à.
Hả?
Vốn ở này bán nha.
Cái nào?
Cái gì thì á.
SIP á hả? Đó, khi lên thì có bán.
Bán hả?
Ok. Mấy người mà không biết chơi nó đơn giản lắm.
Của anh ở chỗ YouTube là gì vậy?
Robert Lamb Channel.
Robert hả? Robert
Lamb. Họ Long á. Họ Long á.
Robert là ADOB.
E R O B E O T B O T. Để tao link cho mày coi, ok. Quay tao link vô cái mày bấm rồi subscribe chứ.
A R O B E A R gì nữa?
O B O T.
O T à?
Thấy không? Lem họ Lâm á.
Lâm đâu thấy rồi. Em nắm vô cái YouTube đó tìm nó không thấy.
Channel có bấm channel. Channel là đài á. Thấy không? Chưa thấy hả? Từ từ đi. Đang lên phim nè. Thằng nó hồi nãy lên 45 đồng nó đi xuống, tại vì còn 26 rồi. Dễ sợ không? Nghe hả?
Gỡ cái tên qua đi.
Quay.
Gỡ qua tin nhắn rồi đánh vô nó thấy cái liên quan, chứ không phải đâu thấy đâu.
Từ mạnh để nó bấm này. Thấy chưa? Thấy thằng Minh Tinh á. Minh Tinh á. Đóng phim chơi Trung Quốc á. Xình lòn á.
Mặc áo da rồi
Vậy cũng mày cũng chưa sợ. Chỉ quá. Ok. Lên đừng có bao lên đừng bao giờ bán, ok.
Bấm vô đó đăng ký không?
Thì vô coi mạng đang trực tiếp á, chữ like. Like là nó ra thôi.
Nó đang nhảy á.
Dữ lắm. Tao chỉ cho mày đang coi, tao chỉ cái hãng rồi vô rồi, ok. Giải này nè quý. Đó, giải rồi đó, 27 đó. Thấy chưa? Mà bữa trước này nó xuống 1 đồng này ha. Bây giờ nó bò lên ha. Nó đang bò lên, nó sẽ lên 1,5 đồng. Nếu mà có tin tức good á, nó rít 1,5 đồng á, vẫn đi trên 1,5 đồng đi luôn, ok. Là dù giàu luôn á. Okay. Này, coi 5 năm về trước này, ở dưới tút này sợ gì chứ, thấy không? Có thấy không? Đang trực tiếp mà. Học cái gì á cũng phải có computer. Đâu có học mà bằng cái điện thoại đâu. Nó khổ vậy. Ai cũng muốn kiếm tiền ấy, mà ai cũng làm biếng ấy. Vì vì sư phụ với mi mặc đồ võ ra dạy mà đệ tử tới rồi mặc áo vest rồi đỉnh ngó không làm học làm cái gì, đúng không? Nói thêm bực nữa, nghĩa là không có nể sư phụ vậy thôi, đơn giản vậy thôi. Vì tao ra tao không có nói nhiều là vậy, nhưng không thích là thôi nói chi. Cái này biết ăn tiền dữ lắm, đúng không? Không phải muốn học, không có tinh thần, không muốn sống gì hết rồi, cái nghĩa nó tới thì nó tới, tinh thần biết liền á, chứ không phải nữa. Giống như quýnh bóng rổ cũng vậy, ai không biết quýnh bóng rổ mà không có tinh thần thôi. Còn mấy thằng giỏi như Kobe rồi, sáng sớm 5 giờ sáng là nó tập rồi, thì đó. Còn mấy người không thích thì nằm ngủ mẹ rồi, sao ra là quýnh thắng người ta được.
Kobe nói tội nó ngồi máy bay giấc máy bay chết mẹ rồi.
Vì lỗi của nó, lỗi của nó đâu lỗi của ai đâu. Ok, Cái thằng mà lấy máy bay á là giỏi lắm, mà lỗi của nó là nó nổi tiếng quá. Cái thằng nó nể phải bay thôi, chứ ngày đó nó thấy bay nguy hiểm mà. Mày thấy không, ở đời không, mày nổi tiếng cũng có lỗi của mình ha. Như vui với mày nói bay, cái thằng kia nói không, bữa này nguy hiểm, mày chờ ngày khác đi. Nó chửi mình một mắt, đúng không? Mà vì thằng khu bì nổi tiếng quá, thằng này kêu ok dạ cho bay, đúng không? Thằng gì ta nói lỗi của khu bì là vậy. Thằng khu bì make decision mà khu bì thì không biết lấy máy bay. Mà cái thằng mà máy lấy bay á là nó sợ khu bì, nó đâu có make decision, nó nghe khu bì. Hiểu cái lý của mày chưa? Ở đời nó vậy. Thì mày nổi tiếng quá dễ bị chết là vậy.
Anh đang like cái PR là gì thì cộng 40%
400% chứ 40 nhầm gì?
Đấy, 400 chứ.
Đó, vậy sao?
Cái LEE
nữa. LEE rồi. Đó. Hồi nãy là có 3 đồng mấy mà lên bột lên quá chừng luôn. Lên 5 đồng luôn. Ha.
Kiếm mà mấy người đầu tư lớn kiếm.
Thì như mua 500 share du kiếm ngàn mấy một ngày muốn gì nữa.
Lúc đó thảy thôi, kiếm được ngàn mấy là bấm bán.
Không phải như vậy, khi nó lên nó kêu nó xuống thì mình mới bán. Chứ nếu mình lên mình bán thì mình bán hồi 4 đồng rồi. Hiểu không nói không?
Thì bán uống thôi, ví dụ mà mình không biết mình bán lại thì uống thôi.
Thì uống thôi, từ từ học.
Giống như mấy người mới nó đâu biết chừng nào lên, chừng nào xuống đâu, anh có kinh nghiệm.
Không, mày cũng không có biết. Mày không biết luôn. Okay. Cái problem là sao không? Mày chịu nghe cái thị trường. Thị trường nói sao mày nghe vậy chứ không phải là mày biết. Mày không biết cái giá lên cỡ nào. Đấy. Mày biết thị trường nó nói đang lên. Với mày, cái thằng mày kêu du mua đang lên, cái du kêu bán. Vì trong đầu du nghĩ nó đi xuống. Hiểu chưa? Con người hồi nào cũng sai hết, thị trường hồi nào cũng đúng, mà tự nhiên mình thấy nó lên cái mình nghĩ nó đi xuống. Hiểu chưa? Là một bài học đó là cái market nó đang lên mà tại sao mình suy nghĩ làm cái gì, mình không biết gì hết. Chính là vô là không biết chơi gì hết, mà tại sao suy nghĩ make decision không cho thị trường nó là make decision. Hiểu chưa? Hiểu cái lý chưa? Thị trường là đúng hết, thị trường là master, biết hết trơn. Thị trường không bao giờ sai. Tự nhiên mấy ông không biết chơi cái thấy nó lên cái kêu bán vì sợ nó đi xuống. Thấy nó sai chưa? Mà con người mình nó sinh như vậy. Với mình sáng sớm dậy là phải đối bụng kiểu vậy. Thấy nó lên cái tự nhiên nghĩ nó xuống. Thấy lottery cái 1 tỷ đồng cái nhảy vô mua, tưởng tượng mình trúng. Nó không có work, cái gì trong não mình suy nghĩ nó không có sự thật. Thấy có lý không? Không, mình phải coi cái chart thị trường nó quá rẻ, như bữa trước cái thằng S&P 258, 278 rẻ gì hết, wow, cơ hội tấp liền. Dù không có tiền. Mà nếu mà vô ngày thứ nhì mà vô mua thêm $700 nữa là bây giờ kiếm cái được 500 nữa chứ không phải giỡn rồi. Đúng không?
Chỉ được số hả?
Hả? Thì vô mua được bao nhiêu? 6
500 á thì
bao nhiêu mẫu giống như 2 đồng mấy mà năm 2 đồng mấy thì vô có 7 đồng thì mua được 300 coin. 300 coin bây giờ lời được một coin 20 cent, muốn gì nữa. Thấy chưa? Một coin 20 cent, 300 coin là thấy $600. Có mấy ngày?
Bữa mua có 180 mấy coi à.
Lỗi là không có tiền. Ví dụ du chê tiền 4.000 ít, mấy kêu 4.000 mà du giữ đàng hoàng. Mẹ em biểu không nói chi. Im. Thì đúng rồi, mà tại sao không nói mới biết, mày đâu có biết thì dù có. Mày biết là thấy khác, chuyện khác liền đó. Ở đời nói láo, mà không phải nói láo. Thì phải, mình nói chuyện cả 2 năm rồi đâu nghe mày nói mày có tiền của nó không?
Có chứ.
Hoặc là I don't know, mày không biết, im, mặt ngầu, Tôi không chơi. Đồ mà thế rồi bỏ 4.000 kêu không chơi. Cũng thiệt chứ. Là năm này năm hay của vui không?
Năm 2001 á, tháng
Lúc đó mà vui. Ok, 4.000 hồi đó mới kêu vô mua Bitcoin là bây giờ vô giàu rồi. 4.000 bây giờ thành mua mấy. Gần 1/3 coin muốn gì nữa, gần nửa coin đó. Mà không phải như vậy nữa, mà chịu nghe bỏ thêm tí tiền 500 cũng được coin rồi. Không chịu thôi. Đời thế mà im. Mấy chợ lớn này im dễ sợ, biết cái gì im không chỉ.
Biết dịch chợ lớn im nữa chăng?
Đâu chị vậy là quá chuyên nghề, biết cái gì bán rồi mà hoành thánh thòn mà không chỉ ai đâu, hỏi sao nấu là không bao giờ chỉ. Tại sao mi chỉ? Tại sao mi chỉ? Mi là American, không? Khổ. Nè lên YouTube chỉ hết nè. Đã chơi stock này, nó chỉ hết chứ, không có gì xảy ra, vui vẻ như thường, đúng không? Chứ mình vui nói bán cái mình chỉ liền lý do tại sao vui nói bán. Cái não của vui là không biết chơi, mà tự nhiên suy nghĩ là biết hết. Ok,
thấy về vốn mà bán thôi nữa.
cái đó không phải cái này phải kiếm thêm nữa để vẫn lên, để kiếm thêm, không có phải lý do đó rồi bán. Ok,
Tập chơi thôi.
Tập chơi là chập sai hết trơn. Tập chơi nghĩa là phải nghe thị trường, không nghe mi, không nghe ai hết. Đó, với mấy thằng Island đó, bữa trước cũng vậy, bỏ ra 8.000 đô mua Dogecoin. Trước đó mi nói biết chơi không, nó kêu không biết. Mà khi mà nó mua 8.000 Dogecoin rồi 70 cent, mi nói bán đi, cái nó cũng nói như vậy, sẽ còn lên nữa. Thấy không?
Đúng rồi.
Đó, mà mi thấy
70 cent là đỉnh của nó rồi, nó rớt xuống.
Mà mi thấy nó xuống, mà trong não nó khi nó bỏ tiền vô, nó thấy nó lên. Thấy chưa? Mà nó trước đó tháng mi nói để mi chơi, mà nó nói là nó không biết. Mà lúc đó khi nó bỏ tiền vô là nó biết hết.
Có thằng bạn của chị á, nó lúc đó nó lên.
Tại sao mình không bán? Mình không bán.
Nó không thèm bán, nó đợi nó nói.
Nó bán không. Ok. Nói đơn giản, bán không được chứ không phải không thèm bán. Dùng chữ không sai. Sao nó xuống 40 cent rồi nó không có lên nữa, cũng bán không được. Thấy không? Cũng xuống 20 cent, nó đâu có lên nữa đâu, mà lên nó đồng 2 đồng. Và con người mình bán không được. Nói trước như vậy, ok?
Nó rớt xuống còn có 10 mấy cent nữa.
Cũng bán không được, biển đâu có lên đâu. Hồi xưa khi lên 70 cent trong đầu nó còn lên nữa, đúng không? Cái chữ còn lên nữa. Cái khi xuống 40 cent đó, cái là nói nó không có còn lên nữa, mà hy vọng nó sẽ lên lại, về vốn tao sẽ bán. Hiểu chưa? Con người tự nhiên nó chuyển à. Đó, mà khi 20 cent rồi kèm mẹ nó, với mấy du mà từ 4.000 xuống còn ngàn mấy, kèm mẹ nó vậy.
Đúng rồi.
Đó, không nói mình nghe luôn chứ bộ. Vì mình nói mà 4.000 mấy rồi, trừ từ đi rồi vô coi. Cái thằng mà TLRY mà lên 1,5 á, mà lên đến 2 đồng á, là hồi đó là mi dù có vốn rồi mi chỉ tiếp tục vậy thôi. Thì có lý chưa? Nghe đã không? Nghe đã chưa? Muốn bán SRP đi. Muốn bán SRP mua cái thằng TLRY đi, vậy thôi. Cái thằng dù có sẵn á, 2 thằng TLRY thì cái thằng dù đang có đó, đồng 20 mấy đó.
Đồng 20 mấy là TLRY đúng rồi.
Bán cái thằng SRP đi. SRP nó lên tới đó, cũng lên từ từ chậm rồi, nó sẽ lên nữa mà rất chậm, nó không có double bằng cái thằng này. Nói trước như vậy.
Giờ mình nhảy vô mua cái thằng
bán thằng SRP lại lấy lời cái thằng đó, tấp qua thằng này, mua hết qua thằng này. Được chưa?
Bây giờ bán hả?
Quá, thì nói phải làm chứ, lúc nào. Chứ bây giờ bữa trước tôi nói mày mua đi, mình nói dữ lắm mày mới mua chứ đâu có mua.
Rồi tấp vô cái thằng TLRY Việt
Việt đó. Thấy chưa? Đồng 27 tấp vô.
Hút luôn á.
Chứ sợ gì nữa. Nhớ bữa trước không, tôi này nãy mày dữ lắm, mày biết làm được chuyện đó. Bán cũng không bán luôn chứ không. Bây bán không được. BB.
Kỹ thuật số. Mua cái thằng thiết keo hoài phải không? Thằng này đang kiếm được 6 mấy đô mà.
Thì bán được, mua nữa, kiếm nữa.
Bán là sale á.
Bán là sale. Chưa biết sale luôn á. Mà khi bỏ tiền vô là Du phải nghe mi, đừng có nghe cái não của Du. Ok?
Sale on phải không?
Yep. Hiểu chưa? Du nghe mi, đừng có nghe cái não, ok?
Mẹ đó.
Yeah, đâu có gì đâu. Mẹ cái thằng BB đó giữ 7, 4, 5 năm luôn, 2000 mười mấy luôn mà không bán được luôn. Này nỉ lắm, bị kịp bán đi, chửi dữ lắm mới bán. Ghê không? Khó không? Du thấy khó không? Tự nhiên não nó làm không được. Con não nó đưa xuống cái tay mà cái tay bấm thôi mà nó làm không được.
Mẹ đó rồi.
Yep.
Bây giờ mua cái thằng XY phải không?
Mua thằng TLRY.
Đang chuẩn bị mua.
Mua đầm 20.
Mua được không? 6 phút à?
Mua đi, mua được. Mua liền. Ngày mai nó có tin tức là thấy lên 2 đầm bạc liền.
Còn 500 mấy nó đây nó không có để mua hết luôn. Thì mua hết là mua sao? Thì
để mua hết, để 500 mấy quá. Thì tập chơi đi, phải biết dùng chứ.
Còn nhiều tiền.
Thì còn bao nhiêu mua cũng được. Mua
500 đi.
Mua luôn đi. Quá tiếc nữa không?
594 đồng à.
Thì mua 559 quá.
594 đồng 35 cent mua hết luôn à.
Sau này mình tỷ phú mình quýnh 1 triệu chứ.
4 đồng 35 cent.
Vui không? Thấy chưa? Có tiền vô là thấy good phong水rồi, ok? Hả? Thấy không?
Sao? 594 đồng 35 cent mua hết luôn hả?
Mua hết luôn đi. Tập chơi chập biết dùng cái máy.
594 đồng 35 cent là mình là chấm phải không? 35 phải không?
Đừng có mua IMPP ok. Cái đó của thằng Ken đó, nó giữ, nó không có bán đâu. Có thằng Ken ở Texas đó, nó thích IMPP đó, đừng có động tới. Mua không nổi rồi. Nó lên dữ lắm, IMPP. To the moon đó. Đang livestream có một bạn nói mua IMPP mà trước lỗi quá chừng luôn, vậy tiền nó nói mua kìa. Thằng này ác lắm. Nó dân chị lớn đó, nó chỉ, nó đang lỗ cái nó chỉ mình mua. Thấy không? Thấy cái Lase Việt á. Lase Việt là trẻ lớn á. Nó đang chỉ mình mua IMPP.
Mấy xe rồi?
Hả?
Mua vô thành ngàn mấy xe luôn.
Là chuyện nhỏ. Ngàn mấy xe là good rồi. Chuẩn bị đi. Chỉ có chờ good news của ông Trump thôi là nó dột.
1024 xe rồi.
Vậy sợ bữa trước 104 mua là có lý nhất ha. Cứ chờ đi. Thằng này nó đang break out bữa này á. TLRY. Chứ đừng có mua IMPP phải không? IMPP là
bữa hổm anh kêu mua 700 á.
Mua
700 á, bữa hổm mua đó.
Yep. Theory quá. Kêu là theory á.
943.
Mấy bữa này là computer trading không à, khi mà hết computer trading là nó nhảy đã đó.
Mua thêm 500 mấy nữa à.
Đúng rồi, mua đi. Thằng này hồi xưa biết bao nhiêu không? Coi này 5 năm về trước này, ta đang livestream ta chỉ nè. 3 năm về trước á là nó 5 đồng bạc. Thấy không? Thấy cái cho không? 5 đồng, bây giờ còn có đồng mấy. Thấy không?
Bây giờ mua cái này. Bây giờ này nó còn mua được nha.
Còn
còn
mấy phút mà chưa tới đóng cửa mà còn 2 phút nữa.
2 phút nữa đóng cửa rồi.
Mà FTA cũng mua nữa.
Nó xong rồi, nó vô rồi.
Vô rồi. Giá trung bình bao nhiêu vậy? Tầm mấy?
Tầm 27 cent đi rồi mua.
Cộng bữa trước mình mua nữa kìa.
Mới mua nữa là đồng 27 cent.
Bữa trước kìa là mua đồng 26 à. 25 à.
26.
Thì đúng rồi. Bây giờ chờ
Kêu
bữa trước bỏ vô 500 kiếm 60 muốn gì nữa, cái thằng kia tỉnh bơ chắc chắn rồi.
mấy chục rồi.
Thì tự mình mua ít, mình mua có trăm mấy xe muốn gì nữa.
Kia là mấy chục à.
Đúng rồi, mấy chục cũng tiền gì chứ để ok, ăn 10 đồng, ăn 10 đồng, ăn 10 đồng cũng là good, ok, ăn là ăn, không có thua là good rồi, ok, chơi này không thua là good, vậy thôi.
Kia kiếm 6 mấy đồng thôi, kêu bán luôn.
Bán đi, thì thằng đó lên tới 3,5 đồng là maximum. Vậy thôi. Ok, coi đi livestream á, lên mạng hỏi.
Rồi bye bye nha.
Bye. Ken, TLRY. TLRY, baby. Có good new TLRY là lên $1.50 liền. $1.50 right away, guys. This guy right here, $1.50. If it break, right here, look, theory guy, the cup and handle, okay? It called the cup and handle. Right here, theory guy, theory. Look at this one. I say what? 20, 22, 24, right here. All right, NFTG moving. Look at this one moving. Oh, this one moving too. This is a crazy one here, guys. This is a crazy one right here. Moving. FTR. Look at it. FTR, guy. MGSI always move. Removing, not move. Dead. Dead guy. Told you guy. Go to 21, 22. Right here support. This one tomorrow squeeze I buy. I did buy tomorrow. All right. What's that? Tesla moving down. Tesla doing down, guys. TLA. Tesla dumping. Dump to 200, 400. Hết lại tích tích tích. Ok. All Alright, this one 34, guy. If this one break 34 foot, it's $30 and 34. You see the moon. Alright, 32, 30, and 34. Everything can happen, guy. Everything. Yep. Yes, sir. Look right there. Alright, wait and see right here, guy. Wait and see. When you see wait and see right here, wait and see. Wait and see right there. Remember I said here 52 or 54 at the top, so under 29. It makes sense? Right here, 29. You see that? VWAP, boom, boom, boom. So under right here, the VWAP. And here, double top. Classic, guy. Classic. Cannot break 30. Cannot break 30. Alright, everything in Mickey Mouse. Only right here, guys. Only right here. Only right here important. Right here. Okay? One line only, guys. One line only. It's support right here, 24. You break 24 all the way down to $20. 18. 18. Look at this one. Told you guys moving. Look at that. Crazy. This one can run, okay? Look at that. Told you. Pull back, boom, boom, boom. Resistance right here. You see resistance? Resistance right there. How much right there? 280, not 288. Okay, right here, 288 up here. Yep, 289. Look at that. MTIS. 289 resistance. See it break or not? Look at dumb right there, crazy. That's crazy, guy. That's crazy. Right, I had to go. Gotta do something. All right, bye-bye. Bye-bye, bye-bye.